designed to spur the City of London, but for some, the plans represent a retreat from earlier ambitions. Let's take a look at the futures then. After US markets snapped 5 days of losses, in fact, you've got the first set of gains on the S&P for the month. We'll check in then on how European markets are opening as we lead up then to those producer prices out of the US, a softening in terms of factory gate prices in China and CPI as well, giving room for the PBOC and officials in Beijing to step up that support for that beleaguered economy. Then the focus, of course, switching to the data out of the US as we count down to that Fed decision, 13th and 14th of December next week. The Spanish IBEX currently up 0.5%. The FTSE 100 gaining 0.3 or 23 points. The German DAX also up in positive territory in the first few seconds of trade, up 0.4%. Similar picture over in France, gains of 23 points. We are seeing money move into treasuries as well, yields coming off. Currently, the US 10-year pricing at 3.47. That is a move lower just by 1 basis point. And in terms of a Bloomberg survey of fund managers, this is really interesting as you look ahead to 2023. Expectations that you're going to get low double-digit gains for next year. Here's the cross-asset board then. Futures stateside pointing to gains of 0.3%, building on what, 0.7% gain overall in the session for the S&P yesterday. Stronger session for the Nasdaq. Pound is at 122. That's a gain of 0.2%. We're awaiting additional details, of course. The Brexit gains that the government are hoping to pursue in terms of some of the deregulation in the City of London. The US 10-year, there it is, 3.47, and Brent trading at $76 a barrel. That is up 0.4%. Let's check in on Credit Suisse then, on the news that they have completed the capital raise, a two tranche section of this, of course, and they did complete 98% in terms of the take-up. They have raised $4.3 billion US, and that sets them up for this important restructuring. There's the gain, 2% on the back of that news for Credit Suisse. Of course, it's been a turbulent couple of months and couple of years for the Swiss lender. They have completed, though, this capital raise. There were question marks about whether or not they would get this off. They have, and again, Bloomberg Intelligence saying it does, at least in the near term, cut the risk for the Swiss lender. Gains and investors rewarding that bank on the back of that successful capital raise, 2%. We'll continue to watch that story for you and we'll get you more details in the next hour. Let's bring in Bloomberg's Valerie Teitel now, who's looking ahead to that all-important US producer price inflation. Valerie, what are you looking at? Where are you focused? What is the trends telling us?
Look, Tom, we've had a swarm of data out of the U.S. this week. It was the strong U.S. ISM services. Then we had jobless claims yesterday ticking up slightly. We also had that Chinese export data that came in way lower than expected. All of this is maybe giving us clues that this theme is really starting to pivot around. Today we have PPI, which is going to give us a good hint on what goods inflation might do at next week's CPI print. As we know, goods inflation was the first to spike really earlier on next year. That was driven by commodity price pressures, by supply chain blockages due to COVID. It's come off steeply and drastically. But even Powell notes that the drop in core goods inflation didn't come as quickly as he expected. In my next chart here, I'll show you what the handoff has really been from core goods into core services. You can see here that core goods has been declining for most of this year, but core services still ticking up. This is the stickier components, Tom. It's things like wages, things like rent that tend to lag and they tend to be very sticky, which means once they rise, they might stay there for the next 4 quarters. We've yet to really see this handoff from core goods disinflation coming into services. You know, today's print might give us a hint on the extent of the further drop we could see. Maybe that changes the calculus in the way that the Fed views this inflation market just because of how it could translate into core services inflation. We have the consumer price index next Tuesday ahead of the pivotal Fed decision. I think we're all looking forward to this last Fed decision of the year, looking forward to closing up the books for this crazy year that 2022 has been.
Yeah, indeed. We did see a little bit more softness, arguably, in the labour market as well. Those jobless claims climbing to the highest rate, since February. The focus there, though, on services and the stickiness around that print ahead of those producer prices later today. Valerie Teitel from our markets team, of course, thank you, breaking it down for us and a preview. Now, talking of inflation, China's consumer inflation eased in November. That's as COVID disruptions suppressed demand, giving the central bank some room to ease policy. Meanwhile, Chinese property shares rallied on expectations that authorities may add support for the ailing sector. Joining me now is Bloomberg's China economy editor, Jilly Desus. Jilly, talk us through the latest China inflation data then, and the room that it gives the PBOC and Yigang to further support this economy.
Yes, so what you're seeing here is certainly a weakening of economic momentum in November. This is, of course, from before we started seeing this broad dismantling of COVID zero this week. So there were still some lockdowns that were in effect. A lot of people, pulling back on spending, maybe staying in their homes during the month of November. And given that inflation has really it's been cooling off quite a bit in China. This is in contrast to, of course, much of the rest of the world. The PBOC probably has some room to maybe look at benchmark interest rates in the first quarter of 2023. Maybe they want to revisit the reserve requirement ratio for banks. So they do have a couple of mechanisms there that they can use to ease some policy, because the economy is going to need it, given how much of a slowdown we've seen this year. And really, even as they roll back COVID zero, it's going to take quite some time before things start feeling like normal again in China.
Yeah, I just wonder how those easing measures are actually going to affect the economy, given the turbulence that our reporting team have suggested is in the cards now for the people and for the economy as they try and exit themselves from COVID zero. Jill, what is happening on the property front, though? We've had a drip feed of measures come through from officials trying to ease back on their regulatory squeeze on this all-important sector. Makes up about 20% of China's GDP. What is the latest?
Right, certainly. So what we're looking at now is there's supposed to be a very key economic work conference next week. So policymakers meeting to talk about what's next for the economy. And what we've heard is that the property market could be in focus there. Certainly some suggestions that they could pull back on a lot of the crackdown measures we've seen target the market over the last couple of years. Maybe the phrase property is for living, or housing is for living in and not for speculation, going away, signifying that there could be more easing for that market to come in 2023.
Okay, Bloomberg's Jill Desus in Hong Kong on the property stocks and the boost that they're getting from some of these easing of those measures from officials, and of course breaking down the PPI and CPI data out of China as well. Thank you. Joining me now is Joseph Little, Global Chief Strategist at HSBC Global Asset Management. Good morning, Joseph. As you weigh up the data out of China, as you look ahead to producer prices in the US, CPI next week, and then that decision from the Fed, what is your view on the equity trajectory in the months ahead?
Good morning, Tom. Nice to be with you again. So, yeah, look, you're quite right. These two dimensions to the debate at the moment are around the Fed and around China policy are the key ones. The way we think about it is if 2022 was the year of discount rates, the inflation surge, big repricing of the Fed, that resetting of interest rate expectations by investors across global markets, then 2023 becomes the year of the macro cycles. And our feeling is that we're looking at a global growth recession. I don't think consensus reflects that, either on the profit side or on the GDP side. I think it's going to be a tricky, tough environment for Western economies. And ultimately, many of the concerns of inflation are going to become a greater focus on disinflation as we move through 2023. But the situation in Asia, a little bit like your reporter has already mentioned, is rather different. It's like a parallel world, really, because we're looking at cyclical recovery, the reopening trade, support coming through for the real estate and property sector. So the scope for Eastern economies to materially outperform the Western economies next year looks quite likely, quite possible. And I think then that has some pretty big implications for equity strategy. Bit more of a regional focus, tricky for global equity indexes again next year. Sharp ratios might not be great, but a focus on being maybe a bit more active in Asia, thinking about some of those country selections could be a good way to approach the challenge.
Well, let's stick on the Asia question then, Joseph, and your forecast of, what, 5% growth for China out of 2023. I just wonder if that's slightly overly ambitious. We have some reporting on just how difficult it will be for China to extract itself. I'm just concerned that investors are focused on the headline around the moving away from COVID zero. The reality is, given all the lack of vaccination rates and the challenges around the healthcare system, that it's actually going to be very difficult, that factories are going to lose workers, that schools are going to shut, and then actually the economic reopening is going to be very bumpy indeed.
Yeah, there's lots of uncertainty about the outlook, Tom. You're quite right. There's no. This year has been what we've called the year of the polycrisis. So many things going on, and if that's not enough to remind us that forecasting is fraught with challenges and uncertainty, then it really ought to be. So the outlook for next year, as you say, we've got around 5% as our GDP scenario for China. So we're slightly above consensus on China, but we're considerably below consensus on the US, where we think the recession is really going to bite as we move through 2023. Lots of uncertainty around that. In the context of Asia and China, as you say, we have to really monitor the COVID policy and the reopening story connected to that. It's important also to focus on that property side. But I think we've seen over the last few weeks, and really over the last couple of quarters as well, a gradual turn in policy support, policy stimulus. If you look at credit metrics, the credit impulse measure, broad credit support for the Chinese economy, it's turning. It's not like 2008, 2009. It's not a whatever it takes type strategy, but it's very clear that on a targeted basis, fiscal policy, monetary policy, regulatory policy is all being eased. Now, it's going to be bumpy, and there's going to be challenges along the way. And of course, a global growth environment that is in slowdown mode is not great for Asian exporters as well. So it's not straightforward, but I think if you look around the world, it is really that North Asia zone that you're focused on as maybe being the one bright spot next year. Japan will be the only major advanced economy not in recession in 2023. Big cyclical recovery potentially underway in China, with some significant implications for Hong Kong, for Taiwan, for Korea as well. It's that area of the world economy where I think there's a meaningful disconnect between how we see the economic trends playing out versus what valuations look like today and what is discounted.
Really, really interesting analysis, Joseph. I've got a million other questions I could ask you, but we're running short of time, so we'll get you back on in the new year to kind of stress test some of your calls. Very interesting on your caution around the US and your enthusiasm for EM, in particular the stories around Japan and China. Thank you. Joseph Little, Global Chief Strategist at HSBC Global Asset Management. Coming up, Credit Suisse's wild ride continues with a $4.3 billion capital increase. We'll bring you the details on that story. The stock is up. This is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Welcome back to the Open. We are 15 minutes into the European trading day. Happy Friday. You're seeing very modest gains of about 0.1% across the European benchmark. Futures in the US looking slightly more robust, gains of 0.3% on the S&P futures, the E-minis, and futures, NASDAQ futures up 0.4%, looking to build on the gains of yesterday. Yes, it was the first positive day for the S&P for this month. Let's get back to one of the big corporate stories of the moment then. Credit Suisse completed a $4.3 billion capital increase, giving CEO Ulrich Körner the funds needed to carry out that restructuring plan. Investors agreed to buy 98.2% of the stock on sale in a rights offer. We're now joined by Bloomberg's finance reporter in Zurich, Marion Halftermeyer. Marion, what does this capital increase then mean for Credit Suisse? How much of a success was this ultimately?
This is good news. This means that they have now the 4 billion in Swiss francs that they need to fund their restructuring plan, which was announced a couple months back. The take-up looks pretty good. I mean, it's a little under 100%, but it means, people were interested in this. So it's good for them. It's good news for the bank after a couple of weeks of quite a bit of volatility.
I mean, just the fact that you started your answer with "it's good news," I think that's the first time I've heard that on Credit Suisse for months. Marion, in terms of the CEO and how they work through this restructuring, they have the funds to do it. What is the restructuring going to look like?
So the restructuring is essentially carving out the investment bank. That's a big portion of it. They finally decided, we're going to focus just on private banking, and that means downsizing the investment bank, which has caused a lot of volatility in their earnings over the last couple of years, and is also obviously where we saw the big Archegos scandal. So that's one big part. The other part is they are planning to downsize their employee base, so they're cutting 9,000 jobs, and that obviously comes with some costs. And then they will have to invest in new parts of the business as well to grow.
And where does that lead us in terms of profitability for this bank, returning to quarterly profitability? How far out is that?
So the CEO and the chairman have guided that they do think that they will be profitable by 2024, 2025. But, it remains to be seen, because right now we had such big news about outflows in the wealth management division. Now, they've guided that has stopped, but that's certainly going to impact the quarterly earnings. So we know already they're posting a loss for the group, for the investment bank, and for the wealth management division for the fourth quarter. We'll have to see what 1Q, 2Q look like in the next year, but it's not looking great, and markets are not helping.
Yeah, all about those outflows. Bloomberg's Marion Halftermeyer, thank you on that capital raise. A success there for Credit Suisse, but of course challenging quarters ahead. The stock currently up a little over 3%. Let's switch focus to what's happening here in the UK then. The UK has revealed now a package of post-Brexit reforms to boost its financial services industry, with changes including relaxing ring-fencing capital rules to lighten the burden on smaller banks. For more, we're joined by Bloomberg's Lizzie Burden. Lizzie, is today's announcement what we expected? What stands out? What's new?
Mostly as we expected. Remember, the Chancellor, Jeremy Hunt, in the short time we've known him as Chancellor, what we know is that he doesn't like to surprise markets. But you've got about 11 documents on the Treasury website this morning, about 30 measures, lots of reviews. What stand out to me are that the UK is going to consult on a plan to increase the ring-fencing threshold from £25 billion to £35 billion. So not just keeping it at £25 billion as per the ski-off review. And I should say this only applies to smaller retail banks. Also, the UK is going to introduce its own rules on short selling, so not using the EU's rules. But conspicuously absent from this morning's announcement and from the trail last night are the words Big Bang 2.0. Of course, a reference to Margaret Thatcher's deregulation 30 years ago. Instead, this is to be known as the Edinburgh reforms, because the City Minister Andrew Griffith and the Chancellor Jeremy Hunt are heading north of the border later this morning to formally announce them. But it was interesting to hear Chris Haywood, the City of London Corporation Policy Chairman, earlier on Bloomberg TV explaining why. He says, this is not the Big Bang 2.0, this is nothing to do with deregulation. He says good regulation and good growth are two sides of the same coin. It's very much a watered down version of what Liz Truss mooted when she was Prime Minister.
Okay, so watered down, so that leads to questions about how much enthusiasm there's actually going to be and to what extent it actually juices the financial sector here. But how much of it is down to Brexit?
Well, some of these deregulations, such as on ring fencing, are nothing to do with the European Union. On that in particular, we were an outlier in the UK in terms of our rules on ring fencing. We went beyond our international peers, so we didn't need Brexit to get rid of them. And remember, the UK's finance industry grew to be world leading when we were a member of the European Union. We were part of drafting the EU financial services regulations, and since leaving the bloc, talent and capital have gone to rival financial centres. So you have to ask, is it really the EU that's been holding UK finance back? I'm sure that Griffith and Hunt are going to want to answer that question later today, and also to reassure investors that these measures are going to boost growth, but not at the expense of financial stability.
And they still have that work to do, don't they? Lizzie Burden, thank you very much indeed for breaking down those changes then in terms of easing some of the constraints, at least on the margins, for this city of London. Thank you. Coming up, we will keep an eye on the inflation print, of course, after an easing of prices in China, and it sets us up for the producer prices out of the US. Stay with us. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then destroy you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority. A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Welcome back to the Open, 24 minutes into the European trading day. It is Friday. You're up about 0.1% on the European benchmark. The futures in the US holding on to modest gains, 0.2% on the S&P E-minis after the first positive day for the S&P for the start of the month. Over in Asia, though, it's been a solid session. The MSCI setting itself up for a sixth weekly gain. Property stocks in China soaring on expectations of further easing of some of the regulatory constraints. Looking ahead, of course, to the producer prices print out of the US later today and how that gives us a steer on the Fed decision-making around rates. Let's get to the Bloomberg Business Flash now, though, with Alice Atkins. Alice.
Hi, Tom. US US regulators are seeking to block Microsoft's $69 billion acquisition of games publisher Activision Blizzard. The Federal Trade Commission says the deal could curb competition in the gaming market by limiting rivals' access to the company's biggest games. The transaction would turn Microsoft into the number 3 gaming company behind Tencent and Sony. China Eastern Airlines has become the first recipient of the Chinese-made C919 passenger jet. The delivery is a milestone in the country's aviation ambitions as it looks to take on Airbus and Boeing and follows years of planning, testing and delays. The C919 is due to start flying commercially next spring. Tesla will shorten production shifts at its Shanghai factory as soon as next Monday and delay the onboarding of some new hires. Sources tell Bloomberg the plant will operate 2 9.5-hour shifts per day, 2 hours less than at present. The move adds to signs that demand for Tesla's electric cars in China isn't meeting expectations. That's your Bloomberg Business Flash. Tom?
Alice Atkins here in London, thank you very much indeed. A couple of the movers that we want to focus in on. The importance, of course, of Credit Suisse with that capital raise, and our team in Zurich describing it as good news, for once at least, for Credit Suisse. The stock gaining close to 3% on the back of the news that they have raised $4.3 billion US dollars, or 4 billion Swiss francs, to help with that restructuring plan. Santander in focus after being hit with a fine, a little over £100 million for anti-money laundering failures from the FCA here in the UK, down 0.3. Total Energy, that's down 1%. They are taking a hit of about 3.7 billion as an impairment in the fourth quarter on their links to Novatech over in Russia. Stay with us. This is Bloomberg.
My grandfather got into the mutual fund business because the average investor could not get a diversified stock portfolio, and it was too dangerous to put, your entire savings in it, just a couple of companies. So the mutual fund was created to give a diversified expert management at a reasonable price. Today, we have a phenomenon where companies are waiting much longer to go public. And so in 2000, the average company went public after 3 years. Now, companies are waiting 9 to 10 years because there's so much money available in the private markets. As a matter of fact, there are half the number of public companies that there were in 2000, and there's 5 times the number of private equity-backed companies. So just from an investable universe, you look at the private markets, and it's significantly bigger. So the question is, that return that used to be captured in the public markets is now captured in the private markets. But the problem, as you know, is you're really tied up for a long time when you invest in a private equity fund. And so trying to figure out a way to solve the same problem my grandfather was trying to solve, which is how do you bring those returns responsibly, the democratization of the private markets to the retail investors. And I describe it as a bit of like running with scissors. Scissors is a great tool if you use it appropriately. And so we're focused on trying to figure out responsibly bringing it in to the average investor.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to the Open. We are 30 minutes into your European trading day, and here are your top stories. Pushing higher, European stocks open largely in the green as Chinese inflation softens and traders await today's US factory gate report. The UK setting out a package of post-Brexit finance reforms designed to spur the City of London, but for some, the plans represent a retreat from earlier ambitions. And rights issue bump, Credit Suisse shares open in the green after the Swiss lender secures its restructuring funds in a $4.3 billion capital increase. Let's check in then on these markets 30 minutes into the trading session. Yes, the inflationary dynamics in China giving officials there the opportunity to ease. We'll see if we see similar dynamics coming through for producer prices out of the US. Of course, the monetary response, very different indeed. What would lead to potentially a step down to 50 basis points next week from the Federal Reserve. We have CPI as well out next week. In terms of your benchmark here in Europe, range bound now after opening modestly in the green. You did see upside yesterday for US stocks for the first time, at least the S&P for the first time this month. The Nasdaq ended up higher by a little over 1%. The DAX currently gaining a little under 0.1%. The FTSE 100 here in the UK down 0.2%. We are talking about the story around trying to boost the City of London. We'll bring you more details. Lizzie Burden, of course, reporting on that. Let's switch it over and see how things are playing out across these sectors. A very solid session, by the way, over in Asia, particularly around the property stocks in China on expectations of further support there. Across your sectors here in Europe, travel and leisure at the top of the list, just by 0.6%. Construction and materials also up by 0.5. Bottom of the list, though, energy currently down 0.9%. Telecom, retail as well. Interestingly, on energy, JP Morgan's Kalanovic saying it is time to sell your holdings, at least in the short term, of energy stocks because they've just moved too far away from the underlying oil price. That is something to bear in mind, maybe, for investors. That is a shape of play across your sectors this Friday morning. Let's get back then to another energy story and the geopolitics of energy. China and Saudi Arabia agreeing to upgrade their relationship to a comprehensive strategic partnership, solidifying ties then between the world's #2 economy and its top supplier of oil. For more, let's speak to Bloomberg's Yusuf Gamaluddin in Dubai. How significant is this move then, really, Yusuf, to deepen relations?
I mean, Tom, it's very significant. We had a bit of a feeling that this might happen, and it was formally announced as part of that agreement. They're going to meet every 2 years. I think the other takeaway here is that just in the last couple of hours, the Saudis have announced that they are now wrapping up their meetings with the Chinese. But the conclusion of that is that they're going to continue to work together around the energy markets. The effort is to try and stabilize it. That's a direct quote. You could see this as a quasi-endorsement of China as one of the largest energy consumers in terms of how the Saudis are dealing with the demand and supply issues. So they're kind of telling the world that the Saudis are doing a good job, and that is a message to the U.S., which has been very critical of how Saudi Arabia and OPEC Plus have handled the oil market throughout this year. The other thing I want to point to is the wider set of deals that have come through. One includes an agreement with Huawei to deepen out some of the computing and 5G in Saudi Arabia. That, again, is another signal. It tells the U.S. the Saudis have optionality, and it's going into a space that's sensitive because, as you recall, Huawei was blacklisted away from the U.S. telecoms market earlier on in the year around concerns for national security. So plenty to take in here as regional leaders sit down with the Saudis and the Chinese over the next few hours. Tom.
Yeah, you have to wonder whether the Pentagon in the US is looking at that Huawei deal, particularly as they have a big base, of course, in Saudi Arabia. Yusuf Gamaluddin, thank you very much indeed on that further entrenched relationship then between Riyadh and Beijing. Let's stay on China then. The consumer inflation easing in November as COVID disruptions suppressed demand, giving the PBOC room to ease policy. Meanwhile, in the US, we have PPI data due today, really important for the Fed, and CPI next week, May offering clues on what to expect then from the US Central Bank as it continues, of course, to battle price pressures. Joining me now is Ludovic Subran, Chief Economist at Allianz. Ludovic, good morning. Thanks for joining us. Let's start on the question of China then. Do you expect China to be inflationary or deflationary in 2023 for the global economy?
Now that's a big question because China is really facing this very tough choice between economics and health. like most of our countries faced 2 years ago. And so I think it could actually be slightly less inflationary than before because we have this easing in the making to avoid social unrest. And so that means fewer supply chain disruptions. So we expect China, and you've seen the numbers this morning, it's not too bad. So we expect China not to export too much inflation next year. And so that's actually not too bad for the world. But the Chinese consumer may not save the world this time because GDP, we expect it to be at 4%. You see all the support measures. It may not be enough to avoid the recession in some of the manufacturing and trade economies in Europe, for example.
What levers, that 4% call on GDP growth out of China next year is interesting. We were speaking to HSBC earlier. They have a 5% handle on GDP. What levers are they likely to pull then to ensure that you get growth of 4% next year?
Do you know they already showed what they were able to do on the property markets because, you know, China is facing this depressed domestic property market, just like Japan had in the mid-90s or Spain in the late 2000s. So they really try to ease on the mortgage side. They also try to ease on the public spending side to support, you know, public infrastructure and so forth. So China is really doing what they can on the monetary and the fiscal side. Then the question is really what happened on the export side. And, you know, with the IRA, was what the Americans have announced on the Inflation Reduction Act and the protectionism thereby that is really aimed at China but affects Europe. I would not be surprised that China actually puts in a little bit more subsidies to investment, to R&D, anything that goes actually to the corporate sector, but also anything that goes to the confidence of the economy to rebound in 2023, if it is the year of their reopening. So I say that we put more fiscal stimulus into the economy in 2023.
Ludovic, throw ahead then and look ahead to the producer prices out of the US later today. How much do you expect those core prices, producer prices, to start retreating? And talk to us about the linkages between core producer prices and then that stickiness around services.
So we expect producer prices today to come in lower than last month. So we have like 7.3 or 7.2% year on year for our forecast for these prices in the US. But you're right. The big question is, you know, was peak really behind? And then you have in the producer prices this idea that the monetary tightening should start to be visible because we have this 6 months delay now. So we expect that to be visible. And then in the CPI, you mentioned CPI is coming next week. Yes, I expect stickier core inflation in the US. So we have this energy disinflation that is starting to come in. We have maybe less imported inflation because Chinese PPI is actually still declining. But the big question now is, you mentioned it, services. We saw Black Friday, which was immense in terms of sales. The Christmas holidays, people are going to travel because they want to get out. So I wouldn't be surprised that some of the components of the core CPI continue to be sticky. Semi-durable goods, because people are concerned about, you know, inflation continuing to get high, so they're going to buy now. Services, leisure, hospitality, restaurants. People just want to go out. We just calculated yesterday that, you know, this excess savings from COVID, we still have another 3 quarters to actually eat it up. So inflation has not eroded totally this excess hoarding from COVID because people didn't travel or eat out for a full year in the US. So there is still some tailwind to consumption. So I think this should be visible in core inflation in the coming months in the US indeed.
Okay, so that support from the household balance sheet, that dry powder is still there. Here in Europe, though, Ludovic, how aggressive can the ECB be? And what are the implications for corporates managing debt levels as rates continue to rise?
You know, I mean, the ECB is determined to be, I guess, as aggressive as it could be. I mean, that's really the big learning from 2022. It was, you know, central banks don't think that this war is their war. Their war is against inflation. So they're ready to hike. So we expect the ECB to do another move, you know, in a couple of weeks and then to continue on a hiking path all the way till March or April, even, you know, May 2023, and then pause. We don't expect actually a pivot for the ECB before 24. So that tells you a little bit how it has completely changed from the experiment of zero economics of the past 10 years in Europe. But you're right. The big question is how does it affect the transmission channel? In Europe, we calculated that the interest rate shock that the ECB is ready to do with the terminal rate, let's say at 3% for the deposit rate, that represents 1 point of purchasing power for households in Europe and 3 points of gross margins for corporates, you know. Gross margins is, of course, not, you know, your operating margin, the end margin, but 3 points of additional burden for companies because of the interest rate shock. And we've already seen, especially in the high yield segment, etc., corporates actually retreating from the market, not going to the market. And the main issue is 23 should be okay for corporates because they still have cash, they still have some growth and pricing power. But 24 is a big repayment wall. And so the level of terminal rates of the ECB and this repayment wall of 24 is not a good mix for I would say the spring of 24, for which we still don't have, by the way, a solution to our energy gap.
Okay, well, that's a really important marker on our calendars then, 2024. And that bold call from you that the ECB may not pivot until 2024. Ludovic Souberin, always excellent, Chief Economist at Allianz. Thank you so much for joining us this Friday and have a great weekend. Coming up, pressure mounting on Musk as his bankers consider using new margin loans backed by Tesla stock to replace his Twitter debt. And of course, concerns that he is facing distraction, the board of Tesla, as woes mount for the automaker as well. Stay with us. We have the details on that story. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Inflation hasn't been this high in the UK since 1981.
Then surveillance for in-depth analysis.
Jonathan Farrell, Lisa Bramwitz, Tom Keene, thrilled you're with us.
Inflation in the United Kingdom, brutal.
Underlying food inflation doesn't appear to be that bad.
It ties back to the tenuous situation of what we're looking at with respect to energy.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Welcome back to the Open. 44 minutes into the European Open. Range bound on European stocks, taking something of a breather ahead of that data that we're expecting in terms of producer prices out of the US. The auto sector up just 0.1%. Talking of which, Elon Musk is busy overhauling Twitter, his most valuable company. Tesla, though, facing increasingly urgent issues, testing the faith of some of Musk's biggest fans. For more, we're joined by Bloomberg's Craig Trudell. Craig, why is Tesla's board coming under so much fire from some of their biggest fans and most important investors?
Yeah, we were just talking at the break. I mean, the China market is really in a challenging place. And this is, of course, not just a Tesla-specific story, but you've got a case where the guy who's been running that business in China very successfully the last few years just got redeployed to Texas, where Tesla's had trouble ramping up its facility. In the past, maybe you would see Musk, deploy himself there. he's obviously, got his hands full at Twitter. He's just tweeted in the last couple hours about sleeping overnight at their headquarters. So this is a case where he's distracted. He's having to pull an executive from, one place that's in trouble to another place that's in trouble. And it sort of speaks to this idea that, there's a kind of, vacuum at the top, a void at the top. And so you're hearing some real sort of criticisms being lobbed at the board for, not looking after investors and not ensuring that there's oversight of these challenges that they face.
So how real are those concerns, and how is Musk addressing them?
Yeah, there are limitations, right, to how much they can do in China. Given the fact that these lockdowns are having an effect on everybody. The Texas plant, the big problem there has been a battery issue where they really seem to kind of, take for granted how difficult it was going to be to make their own batteries, and that's, held back production and is going to potentially be a limiting factor for months to come. So there's some limitations to what can be done there, but, this is also a case of narrative, right, where Musk has always, sort of been able to position himself as someone who's, going in, doing the firefighting, solving problems. The guy, is able to, of course, land rockets back on Earth. Surely he can figure out, an issue at the car factory. Clearly, his absence is not good for the narrative, and this is a stock very much driven by that. I also think, the other thing that the board has come under pressure for is a buyback that's been sort of, viewed among some investors as maybe that will help stem the bleeding a little bit. And Musk has kind of, said that is up to the board, and so the lack of any action toward that is sort of cause for concern for those investors.
This is one for our show producer, but I spoke to James Anderson earlier in the week, and he was an early investor in Tesla. He said what many people don't understand is how finely tuned this company is, and that they can run like a machine without Musk being there. Is any credence to that, and how does that position the business going forward?
I think Musk has even pointed to that just in the last few hours on Twitter. I think that may be the case. They of course don't get to this point with just because of Musk, and he had to have really put a team around him that was capable of executing when he was away. Let's not forget that Twitter is company number 5 that he's been running, and so clearly there are people there with real skills and ability to run this company. But again, the problem for some folks in the market is that Musk was the guy at this company, and it's so clear that he is not particularly present at the moment.
Craig Trudell, fantastic for going through what is facing the challenges facing Tesla, and of course Elon Musk, as he juggles 5 different hats, 5 different companies. Sometimes you forget how many of these things he's running. Thank you, Craig. Coming up, European tech firms have faced a challenging year so far, of course, as we kind of touched on there. Coming up, we're going to hear about the state of European tech from the CEO of Atomico. It's one of the leading venture capital firms on the continent. Stay with us. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Welcome back to the Open, 51 minutes into the European trading day, and European stocks are in something of a holding pattern ahead of some important data out of the US on inflation. The FTSE 100 currently off just by one, close to 2 points at 7,470. Now, European tech firms have seen their combined value fall by nearly $400 billion this year to $2.7 trillion. That's according to VC firm Atomico and their latest State of European Tech report. I spoke to Atomico's CEO, Niklas Zennström, and began by asking him the reasons behind this year's setbacks.
What we're experiencing is a trickle effect, or what we have been experiencing, a trickle-down effect from the public market, and primarily where crossover investors, hedge funds who have disappeared from the growth market. And as a consequence, companies looking for growth investments, they're struggling to find growth investors. So, of course, valuations have come down, and on Series B, valuations come down about 57% from the heights of this year in Europe. Series A, 62%, and the volume is down 30%. So will it go down more than that? It's like, we don't know. But I think we're back now to valuations that we had in 2020, so kind of around when the pandemic started. So I think it's more, valuations are more normalized now.
So valuations are normalized, but have they bottomed?
Who knows? I think what was, because there's been so few investments, what's happening now is that founders who have runway, because they raised so much money last year, they've not been out in the market to raise, to test the valuations. So, but we'll expect them to be out raising next year. And I think that this last, few months and probably beginning of next year, there's going to be, the market's going to try to figure out what the valuations are, where founders maybe have expectations of higher valuations, but investors are going to be, looking at historical averages. But what I do think will happen, though, is that there's so much dry powder in European venture capital investors and growth investors. It's over 80 billion. That's what was on the numbers that come out from our report today. 80 billion in dry powder. So investors, venture investors are in business. They want to invest in companies. But what they will do is to have a higher focus on high-quality companies and high-quality teams. So what I expect to see is that the really good companies is going to be very competitive.
Where does that you talk about the $80+ billion of dry powder that the venture capital industry in Europe here has. Where do you expect that to be deployed in the months and years ahead? Which particular themes, segments, sectors are looking most attractive for that dry powder?
I think what we will see, investors are going to be looking at primarily at type of companies when they can see a sustainable growth, and they don't need to have profitability, but we can actually look with more scrutiny on the business model, like will the unit economics works, will they be able to get good profit margins and so forth. There was a lot of venture capital money that went into marketing war and to fuel growth. I think we will not see much of that. And what we're also starting to see more and more because what we look at is the seed stage investors and company formation. And what's really been exciting to see over the last half year is that more and more entrepreneurs are starting companies to address the climate crisis. And they're seeing a problem, and they see, therefore, an opportunity to solve that. And there's a range of different technologies for that. But that's clearly a trend that we're seeing.
Okay, that was Atomico CEO and Skype founder Nicholas Zenstrom. Okay, let's get the Bloomberg First Word News now with Alice Atkins. Alice.
Hi, Tom. The UK has set out a package of more than 30 post-Brexit reforms to boost its financial services industry. As part of the changes to ring fencing, which requires banks to separate retail services from investment banking, the government is to consult on raising the threshold at which the rules apply. Among the reforms, the UK also says it will look to replace EU-era rules on the regulation of short selling. China and Saudi Arabia have agreed to hold regular summits, solidifying ties between the world's #2 economy and its top supplier of oil. In a meeting in Riyadh, Chinese President Xi Jinping and Crown Prince Mohammed bin Salman are reported to have agreed to upgrade the relationship to a comprehensive strategic partnership. The two nations also signed a slew of energy and investment deals. US basketball player Brittany Griner has been released from detention in Russia in exchange for arms dealer Victor Bout, known as the Merchant of Death. While Griner's return was celebrated by many in Biden's party, the Democratic chair of the Senate Foreign Relations Committee called releasing Bout back into the world a deeply disturbing decision. Former Peruvian President Pedro Castillo is facing up to 20 years in prison if found guilty of the crime of rebellion. He was ousted on Wednesday for trying to dissolve Congress and was detained in Lima while trying to reach the Mexican embassy in an attempt to flee Peru. Mexico has said that it would grant asylum to Castillo if asked. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom?
Alice Atkins in London, thank you. Let's check in on some of the individual movers before we close out this hour of programming. And Credit Suisse, of course, in focus for us. A gain there of 2% on the back of a successful capital raise of $4.3 billion that allows them to move ahead with that important restructuring plan. Santander currently down 0.3%. They've been fined a little over £100 million by regulators here in the UK. Total Energy, they have taken a write down as well in terms of their Russian business, 3.7 billion, stock down 1%. Stay with us. Surveillance Early Edition is up next. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, stepping in for Francine Lacqua. And here's what's coming up on today's programme. Pushing higher, European stocks, well, they tread water as Chinese inflation softens and traders await today's US factory gate report. The UK, meanwhile, setting out a package of post-Brexit finance reforms designed to spur the City of London. But for some, the plans represent a retreat from earlier ambitions. Rights issue bump. Credit Suisse shares open in the green after the Swiss lender secures its restructuring funds in a $4.3 billion capital increase. So yes, as we check in on the markets then an hour into the trading session this Friday, there is a bit of a holding pattern ahead of the producer prices, the factory gate prices out of the US, and what it tells us about how the Fed will react. CPI next week, and of course that decision on the 13th and 14th. And it's a glass half full, glass half empty kind of picture in China. Yes, inflation came off. That opens the opportunity for officials to shore up the economy with additional support, but it also points just to the weakness in the economy and question marks as to whether or not further easing in China can really do much as it battles to exit COVID-0. Across the benchmark then, as we said, range bound. The European stocks index, though, the benchmark here for those tech names, gaining 0.3%, had a little bit of optimism around what's happening in the chip space and the semiconductor space filtering through from the US session. The Bloomberg dollar index currently range bound, and here with Bitcoin, 70,206, just a gain of 0.1%, and the ripple effects of FTX continues, of course, and we know, of course, that SBF is facing multiple probes from the DOJ and many others. Across the map then, over in France, the CAC current down 0.2%. Range bound here in the UK, we have that story about an easing of regulations around the City of London. Nowhere near a big bang is the line from Lizzie Burden. We'll be continuing to cover that story for you. Over in Spain, gains of 0.2%, and in Germany, the DAX is range bound as well. So yes, the recession concerns, and to what extent the data then shapes the monetary policy response. And on China, China's consumer inflation did ease then in November as COVID disruptions suppressed demand, giving the central bank some room to ease policy. Meanwhile, Chinese property shares rallied on expectations that officials may add support for the ailing sector. That fed into, by the way, a sixth weekly set of gains for the benchmark and over in Asia, the MSCI Asia Pacific. But let's stay with China and bring in now China's economy editor, Jill Deisis. Jill, talk to us then about the latest China inflation data and what it means for the future policy response from the PBOC.
Right. Well, really, we're just continuing to see that economic momentum weakening in November. Remember, this is before you saw this dismantling of COVID-0 this week, which obviously is going to take some time to take effect. So what was happening last month? There were still COVID lockdowns, growing outbreaks, record numbers of cases being reported. And really what that meant is that people are staying inside their houses. They're not spending any money. And so you're seeing, that continued cooling inflation data, especially compared with the rest of the world where inflation's been high all year. What that means for the PBOC is that they'll probably have some room to ease policy going into early next year. Economists are thinking maybe there's a benchmark interest rate cut on the table for the first quarter. Maybe you see them taking a look at that reserve requirement ratio for banks and easing there. So there are some options that policymakers have, especially because they are going to need it as the economy is continuing to slow down.
Okay, so possibly a rate cut, a benchmark rate cut in the first quarter. We'll look for that and as to whether that comes through. Jill, when we look at the property sector and the number of regulatory moves that have come through in the last few days and weeks, what does it tell you about how convinced they are that they need to support this sector? Stocks are rallying, and is there a danger that they undo what many would say is the good work that's been done to address the bubble risks within that sector?
Well, certainly it seems like policymakers are taking a look at what's happening in the housing sector. They know that, again, along with COVID-0, this has been the other major drag on the economy this year. We're looking ahead to what's likely to be the Economic Work Conference next week. This is a massive meeting for policymakers in China, where we're hearing that they might stop using that phrase that's been battered around for the last few years, housing is for living in, not for speculation, indicating that they're likely going to take a look at providing some more relief for the housing sector going into next year.
Okay, fantastic stuff. Bloomberg's Jill Dices breaking down the inflation data, the potential policy response, and of course what it all means for the real estate sector, the property sector over in China. Let's get more on the macro picture then, China, and as we look ahead to the US with Sri Kochogovindan, who is the senior research economist, I should say, at Aberdeen. Sri, thank you for joining us in the studio this Friday morning. Let's start with China then, and the window of opportunity it presents for the PBOC to try and stimulate and support this economy, and how that potentially clashes with a very messy exit from COVID-0. How effectful and impactful can that stimulus actually be within this new environment?
Yes, it's definitely a very tricky environment. They've made some very big steps towards reopening and towards moving away, exiting from zero COVID strategy. But it's still going to be quite difficult because of the strains on the health system and because we are seeing rising COVID cases. There have been some key indicators we need to see. Vaccine rollout has to improve. The elderly, there's still not enough elderly population being vaccinated and covered there. So that needs to be improved. That is part of the policy. But it does seem that even with some changes, for example, home quarantining, the fact that we don't have to have mass PCR testing, these are all steps towards it, but still there are going to be those disruptions to activity that's going to continue, and that's really been weighing on the GDP outlook for some time now, and we expect that to continue.
So link the China story then to your call that disinflation will be the key theme. How much conviction do you have as you look to 2023?
Yes, I think there are. If we look at headline, stepping away from China for now, because obviously China CPI we've just discussed, where core is very, very weak there, and that's again because of the activity situation. If we look elsewhere, very different story in terms of activity imbalances, the supply and demand imbalances. Now, the headline is likely to see a sharp deceleration because of the base effects from oil, commodity prices in general, that's starting to unwind. Supply chains are improving as well. So some of those pandemic-related distortions and also the war-related distortions are starting to unwind. There's still some dislocations there. It will take some time, but the impact on headline will be quite sharp, so we'll see a deceleration. However, across US and UK, we still see a stickier picture for core inflation, and particularly core services, and that's where you're seeing new bottlenecks, in a sense, bottlenecks within the labour market, and that's going to be the key story for next year.
Is there a scenario where we have inflation coming down, but the labour market holds up, or is that an impossible scenario? How plausible is it that you get inflation coming down back towards the targets of the central banks, if not in 2023, then 2024, but you continue to have a resilient labour market?
I think that would bring a very challenging backdrop for central banks, particularly for the Fed. In the US, what we're seeing is, as a result of tight labour markets, we're seeing very strong wage pressures, and that's across the board, whether it's occupations, across skill levels, across different sectors, and in particular, where you're seeing, say, if you look at turnover data, quits, that's particularly high in transportation service sector. Again, this reopening, supply-demand imbalances are really focused across services. So because of that, inflationary pressures may still remain quite strong. So you could see a situation where, yes, other components are coming down, core goods prices are decelerating, in fact, negative in the US as well, on a month-on-month basis, but that services sector could remain quite strong. Services prices could remain quite strong, and what does that mean? A soft landing? Not necessarily. The Fed is going to have to hike even more aggressively, and that's going to be a trigger for potentially a deeper amount of economic pain, more jobs.
Right. Well, let's get. I mean, you're highlighting and you've said this in your notes that the services is absolutely key in terms of the trajectory of recession. But let's stay on the of inflation. But let's stay on the question of recession.
Yes.
We were speaking to HSBC Asset Management earlier in the show, and they said actually they favour Asia, and they think that the US is going to actually be in a pretty bad place in terms of the depth of recession. Do you like? It's a bit counterintuitive. Other people have said actually the US is in a much stronger position to kind of weather this storm. How deep is that recession likely to be, if indeed that is your forecast?
Yes, we are expecting the spillovers from the US recession, actually. So if the timing we're not so sure about, and we're not stuck to a timing. We have Q2 penciled in, but really what we're quite
Q2 penciled in for when the recession is
beginning. But what we are very confident, whether it's Q1 or Q3, what we're very confident about is that there will be quite a sharp recession in the US, and that's going to have spillovers across the rest of DM, definitely. Europe and UK already very, very poor leading indicators there, already in recession most likely. And then with Asia, I would say the slower pace of growth in China is really the key to watch there for spillovers. There'll be spillovers from the trade channel with US and Europe, but China is unlikely to meet the CCP target growth. It's going to be much slower growth. We've got 3.5, 3.7 penciled in for 2024. So again, very disappointing growth there. Not a contraction, but slower growth.
And reports suggesting they may set a target of 5%, which for many would be, and to you presumably as well, pretty ambitious for China. Just briefly on the UK, before we let you go, markets are starting to price a little bit less in terms of the BOE. We have the decision next week, December the 15th. 50 basis points, about 54 basis points being priced in by the markets, 100 basis points by February of next year. Is the market getting it right on BOE?
I think that more cautious tone is understandable, definitely, because you have that balance with the fiscal outlook as well. We're not seeing the same level of stimulus, say, in Europe, that we've got some measures there to help with energy bills and utilities, but the real focus now, given what happened to the gilt markets following the mini budget, we're really seeing fiscal consolidation and fiscal credibility. So there, it's a different sort of mix there. Inflation, we do expect, to reach around 11% early next year. So there is, again, this risk that labour market tightness is going to be a problem for the Bank of England. This is something we've seen reflected in a few speeches recently, and this fear of expectations becoming much more backward-looking as well. So it could be much more sticky.
Okay, a challenge again when it comes to the labour market and inflation expectations, maybe 11% here in the UK. Painful still. Shri, thank you very much for coming to the studio. Great analysis and insights as we look at the response from central banks to this inflationary picture and questions about recession. Shri Kocho Govindan, Senior Research Economist at Aberdeen. Coming up, Credit Suisse's wild ride continues with a $4.3 billion capital increase. More on that story next. This is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
A weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. One of the big corporate stories of the day, once again, Credit Suisse completing a $4.3 billion capital increase, giving the CEO the funds needed to carry out that all-important restructuring plan. Investors, they agreed to buy 98.2% of the stock on sale in a rights offer. For the analysis then, let's bring in Bloomberg's finance reporter in Zurich, who's been covering all of this really from day one, Marion Halftermeyer. Marion, what does the capital increase mean then for Credit Suisse? How much room does it give them to breathe?
It gives them the room to breathe for the next couple of months to really embark on this big restructuring plan that they've announced. So they need the funds because they're going to be carving out their investment bank. They're going to be laying off employees. And they're also having to wind down assets they want to get rid of that are just too capital intensive. All of that will take time and money to do.
Yeah, I mean, there's been a drip feed, and you and the team have been covering it in terms of how they plan to restructure. But if we just take a step back and just remind us and the viewers of what that restructuring is likely to look like.
Right. So we have about 9,000 job cuts. That's across the globe and across the bank. But the large part of the restructuring really is this sort of shift from being a global bank that does all sorts of things to just focusing primarily on wealth management. And then with their investment bank, so that's, everything from deal making to advisory, as well as trading, all of that's going to be shifted out and being less focused on. So we're going to be seeing what's called this new entity, Credit Suisse First Boston, being created to really house some of those businesses, and they're looking for external capital to help fund that business.
And will that allow them, within this restructuring, to return to profitability, and can that happen next year?
That's the big question, and they've had a hard time convincing investors on this and analysts. They've been very criticized for, how is this plan actually going to work? Markets are not helping, and the key business they want to focus on is wealth management, and they've had a lot of outflows in that business, so it's not looking super stable at the moment. The chairman and the CEO have both guided that they do think they will return to profitability in the next few years, but the next couple of quarters are going to look really shaky and really concerning, and we're going to have to wait a while to see whether the fruits of this restructuring are actually going to pan out.
Yeah, they have to stem the bleed. So far, the stock up 2.8% in the session. Bloomberg's Marion Halftermeyer on that important news around Credit Suisse. Thank you for the details and context. Now to the UK. The country has revealed a package of post-Brexit reforms to boost its financial services industry, with changes including relaxing ring-fencing capital rules to lighten the burden on smaller banks. For more then, and the details, Bloomberg's Lizzie Burden. Lizzie, is it what we expected? Is there controversy? Anything standing out from you? Any additional risks in the financial sector as a result of these changes?
Well, Tom, most of this has been trailed. We know that Jeremy Hunt doesn't like to surprise markets. You've got about 30 measures, more than 30 measures this morning in 11 policy documents. But the ones that stand out for me are the new rules on short selling. That's moving away from the EU rules to the UK's own. And also this increased threshold that's going to be consulted on for ring fencing, as you say, from £25 billion an increase to £35 billion, which I should say applies only to small retail banks, but it's not in line with the SKIOC review, which had suggested keeping it at 25 billion. Conspicuously absent, though, from this morning's announcement are the words Big Bang 2.0, a reference, of course, to Margaret Thatcher's deregulation 30 years ago, because this is severely watered down from what Liz Truss wanted to do when she was Prime Minister, and indeed what the City Minister, Andrew Griffith, was talking about only only a few weeks ago. We'll hopefully be speaking to him later today on Bloomberg TV. But we have already spoken to Chris Hayward, City of London Corporation Policy Chairman. He says this isn't Big Bang 2. It's not deregulation even. He says good regulation and good growth are two sides of the same coin.
Okay, the Conservative Party, of course, the ruling party, also kind of spinning this as the bounty of Brexit. Largely, as yet, arguably unrealised bounty of Brexit. Is it that? How linked is this to the exit from the European Union?
Well, ironically, given the framing of this as the golden opportunity post-Brexit to create Britain's own rules, on ring fencing, for example, Britain didn't need to leave the European Union to change its ring fencing rules. It had actually gone further than the EU and many of its international peers on ring fencing. And remember, the financial industry in the UK grew as a member of the European Union. The UK played a big role in writing the EU's financial services regulations, and talent and capital have left London since the UK left the bloc. So really you have to ask whether it was the EU that was holding back UK finance. I'm sure that the Chancellor Jeremy Hunt and the City Minister Andrew Griffith, when they head north of the border, I think they're in the air as we speak, will want to address that and also assure investors that these measures are going to boost growth, but not at the expense of financial stability.
Okay, Lizzie Burden, thank you very much indeed on that important change. Even if it isn't Big Bang 2.0, significant nonetheless. We'll be listening out for the Chancellor later today. Coming up in the programme, European tech firms have faced a very challenging year so far. Coming up, we're going to hear about the state of European tech from the CEO of Atomico, one of the leading venture capital firms on the continent. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Let's bring you your Bloomberg First Word News. China and Saudi Arabia have agreed to hold regular summits, solidifying ties between the world's #2 economy and its top supplier of oil. In a meeting in Riyadh, Chinese President Xi Jinping and Crown Prince Mohammed bin Salman are reported to have agreed to upgrade the relationship to a comprehensive strategic partnership. The two nations also signed a slew of energy and investment deals. President Zelensky's diplomatic advisor has told Bloomberg that Vladimir Putin's comments about nuclear weapons should be treated seriously. Commenting on the outlook for the war, he says there is no room for compromise with Moscow on the issue of Crimea.
As a last resort, there is a danger he may use this non-conventional weapon. By the way, not only nuclear, he once threatened about biological and chemical weaponry, so we all should be very serious about this.
US basketball player Brittany Griner has been released from detention in Russia in exchange for arms dealer Victor Bout, known as the Merchant of Death. While Griner's return was celebrated by many in Biden's party, the Democratic chair of the Senate Foreign Relations Committee called releasing Bout back into the world, quote, a deeply disturbing decision. Let's check back in on your markets. The benchmark here in Europe, currently up 0.1%. Some of the individual stories to bring to your attention. Credit Suisse managing to pull off a capital raise of $4.3 billion, enabling it to move ahead with its restructuring plan, being rewarded by investors in the session today. Santander being hit by a fine with regulators here in the UK, around £100 million, down 0.4%, and Total Energy having to write off $3.7 billion in terms of its linkages and investments in Russia. Plenty more coming up, including the pressure on Tesla and Elon Musk. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Pushing higher, European stocks edge up about 0.2% across the benchmark as Chinese inflation softens and traders await today's US factory gate report. The UK sets out a package of post-Brexit finance reforms designed to spur the City of London. But for some, the plans represent a retreat from earlier ambitions. Rights issue bump. Credit Suisse shares open in the green after the Swiss lender secures its restructuring funds in a $4.3 billion capital increase. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Let's get from one of the big corporate stories, Credit Suisse, to another. While Elon Musk is, of course, busy overhauling Twitter, his most valuable company, Tesla, is facing increasingly urgent issues, testing the faith, then, of some of Musk's biggest fans. For more, we are joined by Bloomberg's Albertina Torsoli. And Albertina, why is the board, or at least why is so much wrath being faced by Tesla's board? Why are they coming under so much fire, particularly from their own investors?
Well, thank you for having me. This is, there's always some dramatic twist and turn with Elon Musk and Tesla and Twitter. Elon Musk has created this larger-than-life persona for himself. Twitter is the 5th company he's running, but he's just like the average CEO who will not be immune by shareholder angst if the stock doesn't do well. Take Tesla shares. Tesla shares are down 51%. This year. It's a big decline. The car maker is facing issues. These are not issues that, only Tesla is facing. The global automotive industry is under pressure for various reasons. Obviously, one of them is the slowdown in China. But Elon Musk is larger than life, and he's actually busy elsewhere right now. So that's where the issues are coming from right now.
Yeah, he is certainly larger than life. How is he deflecting some of this criticism then?
Yes, he is very active on Twitter, not only running the company and actually sleeping there right now because he's very busy working there. He obviously, he keeps busy elsewhere, oversees other things, and also tweeted that, just because he's not physically present at Tesla right now, this does not mean that the company isn't running well and dealing with the issues, the latest issues apart from the China troubles. There is a problem right now at a plant in Texas, a plant that is, the ramp up is slower than expected because of a battery problem, and this will probably keep the Tesla teams busy. He does have excellent teams, of course, and again, these are not Tesla only problems, these are industry problems. But the problem is, when you are an investor and you bet on Tesla, one of the reasons you bet on Tesla is because of Elon Musk. It's because of his narrative, his capacity to solve problems, to be everywhere, and not having them there right now, seeing him busy elsewhere, this is really adding pressure both on Elon Musk, on the shares, but also obviously on the board. One of the largest individual investors on Wednesday tweeted, Tesla's board is missing in action. So I think this is the reason for the tension we're seeing right now.
Yeah, and indeed. And of course, the situation in China really challenging for this business as well. We have a line crossing the terminal right now. Tesla will suspend Model Y output at its Shanghai factory at the end of December. That coming from Reuters. We'll see if we can confirm that. But it does point to the challenges in China. How troubling is the slowdown in that economy for the Tesla business?
Look, the slowdown is troubling for every car maker, not only Tesla. The problem right now is that they had, the chief of their China operations, a very good executive, has just been taken and sent to deal with the problems in Texas. So once again, there's a sense that there is a bit of a vacuum right now at a crucial time for the company. Again, this is not only a Tesla problem, it's a wider problem, but all other CEOs are, 24/7 dealing with that problem. And the sense is that Elon Musk is busy elsewhere. We'll have to see how 2023 pans out. It's a problem in China. It's a slowdown in China, but don't forget that the China situation also has led to other supply chain problems. There's logistics problems. There are all kinds of problems elsewhere. And of course, a recession or possible recession next year in Europe. So a lot of pressure on Tesla, on other car makers. But again, you know, investors want to see him there and are asking for a buyback. It's taking longer than investors want to get a buyback to prop up the shares. So I think 2023, the end of 2022 and 2023 will be interesting for Tesla and the industry.
Yeah. And absolutely, and Musk, of course, has hinted that maybe he would be in favour of a buyback. But as you say, a multitude of headwinds at a time when his attention is split. Bloomberg's Albertina Torsolo, thank you for the analysis on that story. Now, European tech firms have seen their combined value fall by nearly $400 billion this year to $2.7 trillion. That is according to VC firm Atomico's latest State of European Tech report. I spoke to Atomico CEO Nicholas Zenstrom and began by asking him the reasons behind this year's setbacks.
What we're experiencing is a trickle effect. What we have been experiencing, a trickle-down effect from the public market, and primarily where crossover investors, hedge funds who have disappeared from the growth market. And as a consequence, companies looking for growth investments, they're struggling to find growth investors. So, of course, valuations have come down, and on Series B, valuations come down about 57% from the heights of this year in Europe. Series A, 62%, and the volume is down 30%. So will it go down more than that? It's like, we don't know. But I think we're back now to valuations that we had in 2020, so kind of around when the pandemic started. So I think it's more, valuations are more normalized now.
So valuations are normalized, but have they bottomed?
Who knows? I think what was, because there's been so few investments, what's happening now is that founders who have runway, because they raised so much money last year, they've not been out in the market to raise, to test the valuations. So, but we'll expect them to be out raising next year. And I think that this last, few months and probably beginning of next year, there's going to be, the market's going to try to figure out what the valuations are, where founders maybe have expectations of higher valuations, but investors are going to be, looking at historical averages. But what I do think will happen, though, is that there's so much dry powder in European venture capital investors and growth investors. It's over 80 billion. That's what was on the numbers that come out from our report today. 80 billion in dry powder. So investors, venture investors are in business. They want to invest in companies. But what they will do is to have a higher focus on high-quality companies and high-quality teams. So what I expect to see is that the really good companies is going to be very competitive.
Where does that you talk about the $80+ billion of dry powder that the venture capital industry in Europe here has. Where do you expect that to be deployed in the months and years ahead? Which particular themes, segments, sectors are looking most attractive for that dry powder?
Yeah, I think what we will see, investors are going to be looking at primarily at type of companies when they can see a sustainable growth, and they don't need to have profitability, but we can actually look with more scrutiny on the business model, like will the unit economics works, will they be able to get good profit margins and so forth. There was a lot of venture capital money that went into marketing war and to fuel growth. I think we will not see much of that. And what we're also starting to see more and more, because what we look at is the seed stage investors and company formation. And what's really been exciting to see over the last half year is that more and more entrepreneurs are starting companies to address the climate crisis. And they're seeing a problem, and they see, therefore, an opportunity to solve that. And there's a range of different technologies for that. But that's clearly a trend that we're seeing.
Okay, that was Atomico CEO Nicholas Zenstrom on the challenges facing this tech sector as it squares up to 2023. Coming up, wild wins and staggering losses. If you put your money on some of the World Cup's unlikeliest outcomes, how much you've actually made. We're going to be live from Doha with some answers. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Now, what a World Cup it has been, with all the controversy about being hosted in Qatar, but there have been some shocks and stunning wins, of course, and we are all looking ahead, at least I am, to England versus France, slightly quaking our boots about Mbappe. Joining us now, though, for a prediction on the ultimate finale is going to be Joachim Clement, who is an investment strategist at Liberium and has built an economic model that predicts, at least you claim, Joachim, predicts the outcome of the World Cup. And to give you your credit, you've done it successfully, 2014 and 2018. Talk to us about what your prediction is for this year. Are England going to do it? And what is behind this economic model?
Well, the good news for England fans is England is going to make it into the final.
And win.
No, the bad news is they're going to lose this one. They've been in one before, they won that, but this year's prediction from us is for Argentina to win. It is based on, as you mentioned, this economic model that is based on some economic factors that, quite frankly, I produced 8 years ago for the first time in a way to satirize economists' hubris in trying to predict absolutely everything. And then actually I was right twice in the last 2 World Cups in predicting the winner.
So it turns out that actually predicting the World Cup winner is easier than predicting inflation?
Definitely, it seems. At least this year it seems to be much, much easier. It points to a truth when it comes to World Cup, namely the fact that while there are a lot of upsets, and trust me, I've been sweating a lot after Argentina lost against Saudi Arabia in the opening match, there are some really important factors at play that make a team good. And they don't necessarily have to do with the individual players, but with the infrastructure in place.
So talk to us about that then. That is really interesting. I know you started this as a bit of a nod to economic forecasting and how fallible it can be. But what are the components that you've built into this model then?
Yeah, so there are essentially 4 components that are in the model. Number 1 is the temperature, the climatic conditions. You have countries where you can play football all year round are clearly at an advantage versus countries where it's too cold in winter or too hot in summer. Then you need a lot of people. The more people you have, the bigger the talent pool that you can select from, and the more likely it is that you will produce stellar players. And then the third question is basically what we use is GDP per capita, the wealth of a country. If you are too poor, look at Nigeria and other African countries, they might have a massive talent pool, but not the money to put the infrastructure in place to actually develop these talents and become world-class players. And then fourth is a cultural phenomenon. Countries, particularly in Latin America, are much more football obsessed, and they have an advantage because that means more people are playing the game and you have more talents.
So it's a cultural aspect as well. I'm going to throw in a country that ticks at least 2 of those boxes, wealth and a large population, that is terrible at football, and that's China. They didn't even make it into the world. I can't remember the last time China has qualified. Massive fan base. They love the sport. They have their own teams. So what's going on there?
Yeah, it's indeed true. China and India are the two countries that should, on the face of it, do really, really well. The Indians have decided to play cricket, God knows why, and the Chinese, for some strange reason, have never really caught up on that. China is the big outlier in this kind of model to the negative, in terms of not being as successful as they should be, while there are other countries, and I particularly point out the Netherlands, a country that is relatively small, but has been incredibly successful at football over the years and decades.
So what are you going to do if your prediction is England, Argentina in the final, England ultimately lose, Argentina win with Messi at the helm? If that doesn't come to pass, what is your kind of what are you going to do? What is your reaction to that? Have you kind of made a bet within the office?
Yes, well, I've participated in our office raffle, and we got our tickets attributed at random, and I got Ghana, so I'm out of the race already. But I've, in the note itself, actually claimed all the excuses that I can have. After all, I'm an economist with more than 20 years experience. I'm good at excuses. And the number one excuse is, which makes this World Cup so much harder to predict, is the fact that it is in winter, not in summer. So it's in the middle of a season where some players are much more rested than they usually are when we play it in June or July.
It was interesting. So I was looking, there are other models, of course. I mean, and you're going to stick by yours because of the way you've built it. But there's the Alan Turing Institute. They're giving Brazil a 1 in 4 chance of winning. The UK, or England, I should say, 1 in 10 for England. That's the Alan Turing Institute. And then Lloyd's, they put together the collective insurable value of teams' players. And they predict England are going to win versus Brazil in the final. And they got 2014 and 2018 right as well. Anything to say for those models?
I do understand their approach, and there's a lot of merit in them. I'm a bit cautious about using the collective value of the players because the Premier League has so much more money at its disposal and can pay so much more for players that it is a bit skewed in that respect. But there are different approaches. I, as an economist, used the macro approach. That has turned out to be rather better than I expected. To be honest, I'd be happy if the hype dies down a little bit and I for once get it wrong.
Well, let's hope you do, and let's hope England end up being victorious. What is easier to predict then? Is it the World Cup or is it the shape of these equity markets?
It's hard to say, to be honest, because I always thought equity markets are easier to predict than the World Cup, but it turns out that World Cups statistically are easier to predict because there are fewer upsets. But when it comes to the current market outlook, I would say I've got a lot of confidence in some aspects of it, but trying to forecast when this market is going to bottom is just as impossible as whether France will win against England or the other way around.
Okay, we're going to get you back in when England are triumphant against Argentina in the final, and you can dust off some of those excuses you've been preparing.
And I will bring my humble pie, yes.
Joachim Clement with the potential for that humble pie. Thank you very much indeed. That was a lot of fun. Investment strategist at Liberium, of course, has built this economic model around predicting the outcome of the World Cup. He forecasts Argentina win the final versus England. There is plenty more coming up, of course. Just briefly checking in on those markets that I touched on there with Joachim. Currently, across the benchmark European equities, you're seeing on the stock 600 gains of 0.2%, and futures in the US just about holding up. It's all about the producer prices today. Stay with us. This is Bloomberg. We're going to get more on the UK as it unveils a package of post-Brexit reforms aimed at juicing the financial services industry. We bring you the details. This is Bloomberg.
digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Inflation hasn't been this high in the UK since 1981.
Then surveillance for in-depth analysis.
Jonathan Farrell, Lisa Bramwitz, Tom Keene, thrilled you're with us.
Inflation in the United Kingdom, brutal.
Underlying food inflation doesn't appear to be that bad.
It ties back to the tenuous situation of what we're looking at with respect to energy.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. A redhead crossing the terminal now. We know, of course, the Chinese economy is under pressure. They're wrestling to exit COVID-0. Now the redhead that the Ministry of Finance is stepping up with some additional support. They will sell 750 billion yuan of 3-year special sovereign bonds. They'll do that on December the 12th to aid the economy. That is according to a statement from the Ministry of Finance, as we continue to watch for further levers that policymakers in Beijing are likely to pull to put a bottom under this economy. And our reporter out of Hong Kong suggesting that maybe a benchmark rate cut is in the offing in the first quarter. But so far, you're getting a sovereign debt sale to help pump liquidity into the Chinese economy on December the 12th, 750 billion yuan. Right, let's get the Bloomberg Business Flash now. And Credit Suisse has completed a 4 billion franc two-pronged capital increase, giving the bank the funds needed for a comprehensive restructuring. Investors agreed to buy 98% of the stock in a rights offer, raising more than 2.2 billion francs. The remainder of the shares will be sold in the market. US regulators are seeking to block Microsoft's $69 billion acquisition of games publisher Activision Blizzard. The Federal Trade Commission says the deal could curb competition in the gaming market by limiting rivals' access to the company's biggest games. The transaction would turn Microsoft into the number 3 gaming company behind Tencent and Sony. China Eastern Airlines has become the first recipient of the Chinese-made C919 passenger jet. The delivery is a milestone in the country's aviation ambitions as it looks to take on Airbus and Boeing and follows years of planning, testing and delays. The C919 is due to start flying commercially next spring. And that is your Bloomberg Business Flash. Let's get back then to the changes in the City of London here in the UK being announced by the government. The UK has revealed a package of post-Brexit reforms to boost its financial services industry, with changes including relaxing ring-fencing capital rules to lighten the burden of smaller banks. For the details, let's bring in Bloomberg's Joe East. And Joe, how significant is this step? Lizzie Burden's been telling us that officials, government officials, don't want to brand it as Big Bang 2.0. So does it really matter?
Yeah, I think it's massive news, really. I mean, so pre-financial crisis, banks were basically taking retail deposits and putting them into their investment bank. And that led to a contribution towards the financial crisis eventually, because you had an explosion in derivative trading and investment banking. So when the banks came into trouble in the financial crisis, they announced that they had to separate those two things. And that was massive news. I mean, I was at uni at the time. I remember we learnt about this, and it was like, this is going to be a big change. This is going to change everything. So this kind of is a very risky thing to do. And I mean, I think that it kind of feels like a bit of a Jacob Rees-Mogg policy. Maybe he's in the ear of Hunt and Sunak, you know, his ex-hedge fund background. It seems like something that the ERG maybe had an influence for me.
Okay, interesting. And then, as you say, there's a risk component as well there that will be scrutinised, no doubt. When it comes talking of risk, short selling, that's being looked at as well. What are the details there?
Yeah, so essentially at the moment you can short sell in the UK, but you can't naked short sell. And this is where you basically agree to sell a stock before you've actually borrowed it. And essentially this inflates the short position on any security because it means that there could be more securities short than are actually in existence. Gets a bit technical and a bit wonky, but essentially it means that there's more downward pressure on a security and it means heavier selling. And that creates a lot more risk. And essentially that's not going to be scrapped, but it's going to be reviewed. They're asking for people to give their thoughts, people from the industry, what they think, and we could see that rule dropped.
Okay, so watching the short selling rules as that review is underway. More broadly, you take a step back, Joe, and we're looking at the financial sector and the City of London losing its crown when it comes to stocks listings to Paris, for example. How do you play this all into that? Where is the City of London at this point?
Yeah, so this news that we're having today is really coming at a time when the UK's Brexit decision is coming under more scrutiny than ever. Yeah. And I think this is really because the inflation situation in the UK is worse than elsewhere. So people are looking at that and thinking, what's the reason for this? And they're thinking it must be Brexit. And also at the same time, you've had the market cap story that you mentioned there. And also some commentary from, I remember Lizzie Burden had a Bank of England member talking about the cost of Brexit. Mm-hmm. We had the Euronext guy on this week saying that the UK has lost its place as Europe's leading financial centre. So there's so much pressure now to put London back on the stage, and I think this is definitely playing into the government's decision.
Joe Easton, thank you very much on these important changes in the City of London. There is plenty more coming up. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller in New York, Anna Edwards here in London. Your futures in the US pointing higher by 0.2%. This is Bloomberg.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return, and to get a long-term return, putting it into private hands is one way of doing it, but really the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is US public sector owned, that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Markets lead the economy. And what they're telling us is that next year, the first half of next year, is going to be a difficult period, both in the U.S. and in Europe.
I think the U.S. economy is going to prove to be more resilient than that.
We've never seen a recession so anticipated. And it does make you, I spent a lot of time on Wall Street, it does make you seem to think, well, maybe I should take the other side of that.
If you think the bear market is not over, I get that, and that's one thing. I think the lows are in, and I think we're starting a new bull market.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. What will the Fed do next? Investors hope key inflation figures out today may provide a clue. The big freeze. Europe may be able to fight it off because of huge stockpiles of natural gas. And the UK unveils more than 30 post-Brexit reforms aimed at boosting the financial services industry. What will the so-called Edinburgh reforms mean for UK finance? Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Kaylee Lines is off today. And Matt, we heard a lot of divergent views there at the top of the program about where markets go from here towards the end of the year into next. But today, it seems, yesterday and today, markets trying to close out at least this week better than we've seen at the start of December.
Yeah, absolutely. It does look like we definitely had a gain in the cash session yesterday in the U.S., and we have a gain in futures today as well. We have some kind of conflicting stories in terms of the outlook for markets next year, and we're going to dig into those throughout the program. Take a look first off at what's going on in Asia. We're seeing gains across the Asia Pacific. This is the MSCI right now, up 1.25%, and the Hang Seng is gaining 2 1/3% as well. So some decent gains there. The Nikkei closing up more than 1% in Japan, and you can see the yen here, the U.S. dollar at 136, buying 136 yen. That's fewer yen than it bought the day before. So definitely risk on in Asia, and that carries over to U.S. futures as well. Not quite as much right now. S&P futures up about 0.2% because we were up over 1% at the close of the cash trade yesterday, and we're still not back to the 4,000 level that we dipped below at the beginning of this month. The 10-year yield coming up just a little bit, still under 350 right now, so 348.69 is the level there after we had climbed to a record 4.25 a couple months ago, at least for this cycle. And then you see NYMEX crude right now up 1.4%, but still at 72.45. So still at levels that we hadn't seen before this week since 2021. Very low level relative to what we've seen throughout 2022 for crude oil. The same is true of Brent. Finally, take a look at Bitcoin up again over 17,000 and holding at that level. So the stability, I think, since the fall of the FTX exchange, in fact, the climb since really Bitcoin was revalued after that implosion is pretty impressive, I think, to anyone watching, although Coinbase may be trading down a little bit in the pre-market. Anna, what do you see in Europe?
Yeah, European equity markets then making fragile gains, modest gains for this morning, up by around 0.2% in the UK and over in Germany. Wall Street then benefiting yesterday from maybe some cracks emerging in the labour market story. And we look ahead to PPI data later on today, that coming ahead of the CPI data next week and the Fed meeting next week. All of that will add up to an interesting picture going into the Fed meeting. And so we see markets kind of in limbo, waiting for a bit more clarity on where the inflation picture and the US economy goes, perhaps. The China story overnight with the slight weakness in the inflation data there, adding to expectations of stimulus. That helped out the margin. Brent crude then up at 1.25% this morning. I put this in because we keep seeing this time of the day that Brent crude is higher, even though the numbers look a little bit low. There seems to be a daily pattern of what's happening in crude markets right now. 85 is where we started the week. We have lost a lot of ground since just the start of this week and actually trade pretty close to the area we traded at the start of this year. Remember, we've been up much higher than this during the course course of 2022 with all the geopolitics that has been playing out. Credit Suisse up by 3.2% this morning. They have managed to put away their rights issue. More than 98% of those shares of the 4 billion Swiss franc rights issue they managed to do that's going to fund restructuring. More than 98% of those going to existing shareholders. Man Group, this is the biggest gainer on the stock 600. The listed hedge fund up by 6.6%. They are doing a buyback, and that is proving positive for investors. And I put in the euro, Matt, 105.58. We have no movement on euro dollar today. But of course, we look ahead to a lot of data out from the US and to the Fed next week and the ECB next week. I spoke to Elsa Linios at RBC earlier on, and she had a really interesting angle on this, saying there's a sort of transatlantic divide, a home bias going on when it comes to assessing the state of the US versus the European economies. And European economists and therefore FX traders are more positive on prospects for the euro right now. We'll see what the data over the next week or so reveals.
All right, very interesting stuff. Now, investors are going to be watching closely. Speaking of data, today's release of the U.S. Producer Price Index for clues on inflation and how the Fed may react. The numbers come out at 8:30 a.m. New York time. DWS Group's Greg Staples spoke with Bloomberg on his inflation outlook.
We also think longer-term inflation is going to be above the 2% that the Fed is targeting. I do think that at that inflation-unemployment trade-off that the Fed has to deal with, they will settle for a higher rate of inflation if that means we can keep unemployment at the 4.5%, which I think is the narrow rate.
Our markets reporter, Valerie Teitel, is here to preview the PPI number. And Valerie, this could change the calculus for the Fed next week. I mean, is it that big, or do we wait for CPI to make the real move?
No, I think it really does, Matt. I think a lot is really undecided for what the Fed's going to do, especially where they put that 2023 dot, which most of us view as where they're going to guide the terminal rate for next year. The PPI data today, it will give us a hint on how steep a drop of goods inflation we might expect to see in next week's CPI print. As we know, goods inflation is what PPI normally tracks quite closely. That was really the first to explode in 2021 based on the commodity price rise, based on all the supply chain pressure as we came out of the COVID era. But really the important thing is how quickly will this steep drop in goods inflation feed into core services. In my next chart, I'll show you how the handoff has been. It's been almost a year of declines in core goods, the year-on-year inflation metric, but really we've yet to see that reflected into core services. And Matt, these are things like wage price inflation, the stickier components such as rent. Those have really have not turned around, and Powell has reiterated over and over again they will not pause, they will not pivot until they are sure that this core services metric has peaked. So let's see if the PPI data today gives us some hint on how the flavor of the CPI number will come next week.
Okay, there's a lot to talk about when it comes to inflation. Then, Valerie, thank you very much. Bloomberg's Valerie Teitel with the US data. Of course, we had Chinese data overnight as well. Now, Europe is bracing for an unusually cold winter, adding more pressure to already soaring energy prices. Bloomberg's European correspondent Maria Tadeo joins us now in London to take us through the latest details. We've all become meteorologists of late, Maria. What does this cold weather, and it has become quite cold here in London, to say the least, of further north. What does this cold weather then, what does it mean for Europe?
And we have to talk about the weather, and it's not in my case, because I've been in the UK, so now I've turned into a full-on Brit, is because this year it really does matter, Anna. And look, it has a lot of repercussions. If it gets very cold, obviously, it means that you draw from storage because you want to heat up your home, you want to heat up your place of work. If you draw from storage, that brings potentially the idea of rationing. That means blackout, and that means, again, the specter of recession in Europe. So I think today there's two real key messages that are coming out from two of the biggest economies. The Germans are saying, the regulator, be very careful about the amount of heating that you're using. We need to be much more responsible on this. And that the French president is suggesting we don't have to panic over blackouts, but we have to be responsible, use common sense with this cold snap. But again, we'll have to wait and see. Of course, if it's cold, you want to turn up the heating.
Yeah, what is then the policy response, Maria?
Matt Miller, my friend Matt Miller, good to be with you on this show. It's been a long time. And Matt, you lived in Berlin. You know it gets very cold there, but then you also know politically there's a fundamental issue that Europe has not come to grips with. And until you fix this debate, you're not going to get a policy response, to answer your question. And the dilemma here is, what matters most? Is it supply or is it the price signal? When you talk to the Germans, they say the key here is supply, especially as you look for storage for next year. When you look to the Italians, they tell you what I care about is cheap. It's a price signal. I need energy, but I can't pay at all the amount of money that the Germans are willing to pay. So until you fix that point, you don't get to a decision. We have an energy ministers meeting on Tuesday. The expectations for that is very muted. And then at the end of next week, European leaders will meet again in Brussels. Can they infuse political momentum on this? That's a question to be seen.
Yeah, I want to point out as well, we're going to be speaking to the CEO of Mercedes-Benz, Ola Kalenius, at 8 o'clock New York time. I'm going to ask him, Maria, what does Mercedes do if Germany implements rationing for factories? Because obviously a lot of their operations run on gas, and they're going to need to rethink their plan.
Can't wait to hear it.
Yeah, that's going to be interesting. Maria Tadeo, thank you very much. Maria Tadeo with us in studio here in London, taking us through some of the themes we will watch around regulation, rationing, price signals around the energy story. Now, the UK has revealed a package of post-Brexit reforms to boost its financial services industry, with changes including relaxing ring-fencing capital rules to lighten the burden on smaller banks. For more, we're joined by Bloomberg's Lizzie Burden, who has details. So, Lizzie, we've heard quite a lot this morning from the UK Treasury. Some of it had been trailed. Did we hear what we'd expected?
Well, yes, Anna, you've got more than 30 policy measures here, lots of reviews, but as you say, most of it trailed. As we know, one thing about the Chancellor, Jeremy Hunt, is that he doesn't like to surprise markets. But two things really stand out for me. The government is looking to increase the ring-fencing threshold by £10 billion to £35 billion, so not in line with the SKIOC review, which said it should be kept at £25 billion. And it's also looking to introduce the UK's own rules on short selling instead of the EU ones, and that would include consulting on scrapping a rule on naked short selling, so really playing into the hands of hedge funds here. But while these measures are significant, this is a real
naked short selling would be allowed?
It's being consulted on, but the point really is, in the big picture, this is really a watered down version of what we had been hearing about under Liz Truss, and even only a couple of weeks ago, Matt, when the City Minister, Andrew Griffith, was briefing, we were hearing about a Big Bang 2.0, but that's not even in the language today. And the reason is that much of these reforms have had to be scaled back. They're now going to be known as the Edinburgh reforms. You've got the Chancellor and the City Minister in the sky as we speak, on their way north of the border to address CEOs.
Wow, so that's cool. I'd be allowed to sell shares that I don't own or even have possession of. Amazing what can be achieved, I guess, after Brexit, right? Is this all what the UK can do post-Brexit?
Well, it's certainly being framed that way by the government, Matt. This is being framed as the golden opportunity to deregulate, having left the European Union, but not everyone agrees with that framing. Take a listen to what Pat McFadden, Shadow Chief Secretary to the Treasury, told Anna and me yesterday.
The truth is that to support this sector, if they were really serious about that, it might have been an idea to think about market access for it when they were negotiating their Brexit deal, but they failed to do that.
Now, ring fencing, of course, is an area where the UK went further in its regulations than the EU, so it didn't need Brexit to unwind those rules. But the message that the Chancellor is going to want to hammer home later today is that these measures will boost growth, but not at the expense of financial stability.
All right, Lizzie, thanks very much for joining us. Lizzie Burden there. She's going to be speaking with the UK City Minister, Andrew Griffith, later on today. So that's an interview you don't want to miss, especially if you're focused on the city. Let's get a look right now at some of the stocks moving in pre-market trading in the U.S. First off, Microsoft and Activision, after the FTC takes a look at this $69 billion buyout, potentially putting it at risk. You can see Activision Blizzard shares are down right now, only about two-thirds of 1%. And Microsoft really unchanged, but still a big story to keep your eye on. And if regulators rule that you can't own the most important video game because you're not letting other people in on your IP, that just raises, I think, a question about IP for so many other things. Take a look at shares in Tesla right now, unchanged. There is concern among Tesla investors that Elon Musk, the CEO, maybe has too much to do with his job at Twitter as well, and there are issues popping up at the car maker that need to be addressed by an executive. Coinbase is down as Mizuho downgrades it to an underperform, saying they're concerned about volumes in trading there. And then DocuSign with a big jump this morning after results beat the street's estimates. DocuSign up 12% in the pre-market. Anna?
Okay, some decent movers to watch out for then there. Let's get back to the macro themes and tell you that coming up on the program, Koku Anguibloa joins us, Global Head of Economics and Cross-Asset Research at Societe Generale. What clues has he been taking from a weakening in the inflation impulse in the United States, maybe later in PPI and next week in CPI, and certainly from overnight in China? We'll get to all those themes. We'll also speak to Kevin Daly of Goldman Sachs as they've set out at Goldman Sachs to gauge the world economic outlook through 2075. They must be taking a very long view. Do we need a new economic model if you're looking that far ahead? We'll be back shortly. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You got to think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. It's a big week for the U.S. economy, and Bloomberg's got you covered.
My head's spinning here.
First, on Tuesday morning, CPI data comes in.
We're seeing things work themselves out.
This is going to be a really choppy ride.
Then on Wednesday afternoon, a special surveillance will cover the Fed's last rate decision of the year.
Power of that Fed speak is declining.
Does this Federal Reserve have the commitment to keep going?
The question is, how high do they have to go?
The CPI report Tuesday morning and the Fed decision Wednesday afternoon. Right here on Bloomberg, your global business authority.
Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller here in New York. Anna Edwards with us out of London. Kaylee Lines is off today. We have a story today on fund managers that I just think is so telling about the buy side versus the sell side. Remember earlier this week, strategists predicted a drop in stocks next year for the first time since 1999. They haven't been that bearish about next year's performance on the S&P 500 for over 2 decades. So Bloomberg reporters got on the phones and called fund managers around the world to see what their take is for next year. Well, fund managers are expecting double-digit gains in 2023. I guess it takes two sides to make a market, right? Joining us now is Lynn Thomas in Bloomberg Markets managing editor. Lynn, why are fund managers, why is the buy side so bullish about 2023?
Yeah, absolutely. I mean, I think, when we're talking to fan managers, they're possibly looking at these cheap valuations and especially getting into these more defensive areas as something that could carry the market. I mean, clearly we've seen a massive rotation into energy and out of tech this year. And so I think part of what you're seeing is some bottom fishing among the investors and perhaps strategists looking at the macro picture and saying it still looks a little bit bleak.
Right. I mean, Lynn, when you look at where we have seen enthusiasm, as you nodded to there, energy stocks have been very popular, of course, this year. Now JP Morgan's Kilanovich saying sell energy stocks from here. This seems to be the basis of their bearish call.
Yeah, and I think what they're looking at is this divergence in energy prices. So energy prices have started to soften, and yet energy stocks have been really strong. So I think what JP Morgan is saying, this can't quite last forever, and we might see a dip in energy stocks.
It's interesting, when you look at oil, Lynn, you see this argument playing out between a reopening in China, that would arguably be good for demand, or a recession due to central bank tightening around the world. That would cause a recession. How do you see that playing out in equities?
Yeah, I think that's exactly the tug of war that's in markets right now. Is it good news because China's coming back, or bad news because we're going to face a global recession? I think, essentially the picture is kind of muddied. And to your point earlier about the divergence between strategists and fund managers, it's exactly that split in the market.
Okay, Lynn, thanks very much. Bloomberg's Lynn Thomason joining us there with the different views that, as Matt says, make a market. Let's just tell you where you can find more market analysis, of course. MLIV Go is the function to use on your Bloomberg terminal. That's where you find the Markets Live blog. This is Bloomberg.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force in the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
You've got to explain this one to me.
What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
China is rapidly abandoning the tough measures which have defined its COVID-0 policy, but as Bloomberg's Stephen Engel explains, little time has been spent putting in place mitigation measures needed to deal with the expected resulting explosion in cases.
While Hong Kong has served as a blueprint for China's opening up from COVID, it's also a huge, huge cautionary tale. Now, when the Omicron variant swept through this modern city of 7.5 million earlier part of this year, the city's sophisticated healthcare system was simply overwhelmed. At one point, Hong Kong had the world's highest death rate due to COVID. There simply wasn't enough space to put all the patients or bodies. Some of the sick were put outside on gurneys as body bags with the deceased stacked up in some wards next to the infected living. Morgues, too, were inundated. Most of Hong Kong's nearly 11,000 total COVID deaths happened between February and April of this year. Like Hong Kong, China has a largely under-vaccinated elderly population, but on a much, much larger scale. And China, too, doesn't have the more sophisticated mRNA vaccinations available.
We have to remember that China has been protected the public for so long. There has been no herd immunity in China. So this is going to start. And this process is not going to be smooth. It will be quite difficult.
With the sudden dismantling of COVID restrictions, including mandatory PCR testing to enter public spaces, China is bracing for a surge in infections and deaths. More than 2 million fatalities by one estimate. Criticism of COVID-0 is rapidly being replaced by concern that the rapid policy shift away from the all-out eradication of the virus is happening too fast, and that China is ill-prepared, like Hong Kong was back in March, for a health crisis of unseen proportions. Stephen Engel, Bloomberg News, Hong Kong.
An important report there from our colleague Stephen Engel on just how bad things could get in China. We'll get back to the markets shortly. We'll get you analysis with Koku Agbubloa. This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and their work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on We've never taken what we could. We've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. What will the Fed do next? Investors hope key inflation figures due out today may provide a clue. The big freeze, Europe may be able to fight it off because of huge stockpiles of natural gas. And the UK unveils more than 30 post-Brexit reforms aimed at boosting the financial services industry. What will the so-called Edinburgh reforms mean for UK finance? I'm Anna Edwards in London with Matt Miller in New York. Kaylee Lines is off today. And Matt, we're all about inflation, it seems, today. We have PPI data due out the United States later on. Overnight, we got the CPI and PPI data out of China looking sluggish, prompting talk of more stimulus to come. And through that, stocks make modest gains.
Yeah, maybe waiting for PPI is why we're not seeing the kind of gains that we saw here yesterday again, or the kind of gains that we saw in Asia overnight. We were looking at 1-2% gains in Asia, and here on futures, we're only looking at about 0.25%, but we're really waiting for that PPI number. As Valerie Teitel told us, it really could be a game changer for Fed policy, and of course, CPI comes out after that. We're looking at a 10-year yield that is coming down just slightly. It had been rising a little earlier, but also not a lot of movement here, right? 347.06, we were at 348 earlier. We're just holding around this 350 level basically over the last couple of weeks. NYMEX crude at 72.18. Right now, that's up 1%, but such a low level that before this week, we hadn't seen that since 2021, a 72 handle on oil. And then Bitcoin climbing up and holding above 17,000. I think it's really interesting, 17,218. That hasn't helped analysts' view of Coinbase, which they see having lower volumes, at least at Mitsuo, and so they've downgraded Coinbase to an underperform. Take a look, speaking of that, at some of the pre-market movers here. Microsoft and Activision, I'm just keeping an eye on because the FTC is concerned about the purchase, Microsoft's $69 billion purchase of Activision. Putting that on ice could hurt, obviously, the shares in Activision. As a result, they're down in the pre-market just a little bit, but wait until this thing opens. And I think it's such an interesting case, right? Because regulators are concerned about whether Microsoft would have control over the most important video games in the world and whether or not they would let other people into those games for revenue sharing purposes. Is just such an interesting IP thought experiment. Netflix right now is gaining. It got an upgrade over at Wells Fargo. They say that next year there should be less churn and more stability in terms of subscribers. So Netflix up 2% in the pre-market. And then DocuSign up more than 10%, up more than 12% actually right now in the pre-market because they have raised their full year revenue guidance. So that stock could be off the races at the bell. Anna, what do you see in Europe?
Just interesting on Netflix, a decent move there. And just in the week that we hear from Harry and Meghan, that's getting all the Netflix coverage over here in Europe. This is what we see in Europe, up by 0.4% on the stock 600 right now. Off earlier lows, in fact. Energy stocks not doing too badly. Brent crude on the rise. That's also off earlier highs. And we've got 76.51 is where we trade on Brent. We have not seen these kind of levels since the start of the year. To your point, Matt, we've come quite a long way when it comes to climbing up the hill on Brent and then coming back down or on oil products more generally. And in fact, we just started the week with an 85 handle on Brent, so quite a substantial, speedy move, despite all of the narrative around reopening in China. Just shows how nuanced that story is. Credit Suisse is rising, up by 3.5%. They managed to do their capital raising, 4 billion Swiss francs in capital raising, more than 98% of that going to existing shareholders. New ones coming in too, though, of course. And Man Group is up by 6.7%. And this company saying that they're going to be doing a buyback, and that is proving popular with investors, Matt.
All right, we'll continue to watch all of those shares as well. Joining us now is Koku Agbubloa, head of UK research at Societe Generale. Koku, thanks so much for coming on the show this morning. What do you think about as Lynn Thomason from our stocks team was saying earlier, the main tug of war in these markets, kind of the reopening of China and the possibility that that boosts demand, and at the same time, the tightening of central banks and the possibility that that causes a recession. Is that the main argument in markets today?
Well, I think it is pretty much. I think it is also a question of the resilience of corporate and household balance sheets, the significant amount of excess savings that is cushioning the inflationary pressure in the cost of living crisis. And then you also have to factor in the fiscal policies with all the measures, like in Germany, 200 billion euros of energy shield to protect against the rising cost of energy. So I think it's also a question of timing, because it takes 3 to 5 quarters for interest rates to hit the economy. So this is why we're expecting a recession more towards the first quarter of 2024 for the US. Clearly, the UK and Germany are already to some extent in a recession. But if you look at the broad economy, these two forces are offsetting each other, and the debate with investors is how big a demand destruction are we going to see towards the second half of next year, and that will determine the path of inflation and then monetary policy. But at the current juncture, the view is for interest rate to plateau from Q2 next year. That will be the first pivot, and then the second pivot will be actual cutting of interest rates as we start to see evidence of a recession or a slowdown in growth.
Well, if we don't start to see a recession in the U.S., Koku, until the beginning of 2024, does that mean, your second pivot, which is really the only pivot coming back down, does that mean we don't see that in 2023 from the Fed?
Yes. So our view is that the rate cuts will essentially occur in 2024. I think the yield curve is sort of expecting a cuts towards second half of next year. But for us, we think it is too early, because if you look at the strength or the kinetic energy, so to speak, of the U.S. economy from a jobs perspective, the fiscal stimulus that is embedded in the economy, and also I think that's also very important. It is the corporate profit margins. They are incredibly resilient because of the operating leverage driven by inflation. In other words, nominal revenues are growing faster than wage inflation, and therefore earnings are essentially being inflated by inflation. And this allows, despite the input cost crisis, businesses to have resilient earnings. So we're expecting earnings to grow at close to zero next year, but it is to put into perspective with valuation having already been derated.
So Koku, good morning. So you think that resilience in corporate earnings, that is something that can continue into next year, despite all of the cost pressures, because you think that revenues also climb?
Yes. In other words, I think if you look at real earnings growth, they are already negative because inflation is around 10%. But we are looking at things nominally. And this is one of the beauty of corporate, or let's say the income statement, and the way inflation feeds through an income statement of a company. So our view is that, in other words, we will see demand destruction and a slowdown, but it is more than offset by the pricing power that some companies have been able to use. And this is called greedflation. In other words, the ability of companies to raise prices by more than what the increase in their input costs would suggest.
Greedflation. I'm sure they call it something else, but it's a point well made, Koku. Let me ask you about China and the reopening story there. We just carried a report by one of our colleagues in Hong Kong, casting his mind back to how stressed and strained the medical system in Hong Kong had become during peak infection. And we now brace to see how many infections and then sadly how many deaths we see in China. So given all of that, what does the trajectory of the reopening story look like for you then, Koku?
Yeah, our view is that it's going to be a gradual reopening. Clearly, the path of least resistance is for reopening because the social tension is something that's unbearable going longer term. I mean, they've been literally in lockdown mode for over 2 years now. When you look at what happened in the Western world, sort of a couple of months created a lot of psychological pressures already. But the thing is, as you mentioned earlier, it will lead to a number of deaths. But the assumption is that they will ramp up vaccination because this is something that was not done as a priority around the sort of party congress review, etc. So as they pick up mass vaccination, that is hopefully will plateau or will lead to a more manageable path of death, which is something they've been trying to avoid. So in other words, the impact on commodities and oil on oil markets is not going to be as aggressive, and the sort of stimulus towards global growth is not going to be as aggressive as most people expect. It's essentially more of a gradual reopening and a tedious reopening, unfortunately.
Coco, what do you think about the performance of the stock market next year? When we ask strategists, they tell us next year is going to be a drop for the first time since 1999, the first time that strategists are bearish about the following year in our survey. When we asked fund managers, they say we're going to see double-digit gains, albeit low double-digit gains, nonetheless, 10% up next year. Where does the stock market go, considering the economic expectations that you've outlined?
Yeah, our view is that the stock market will be range-bound or in a gradual downward drift. Because it will be subject to a death by 1,000 cuts, so to speak, because what we had in 22 was a valuation derating because of higher bond yields. What we're expecting next year is an earnings recession. As I said earlier, it takes 3 to 5 quarters for interest rates to hit the economy. You have a lot of offsetting factors, savings, corporate margin, high unemployment, but all of that will have to face the cumulative effect of tightening. And this is going to be a downward gravitational pull on earnings growth. And therefore, you could expect to see more profit warnings, for example, because CEOs typically have 3 quarters of visibility, or let's say 3 months of visibility in terms of their businesses. So valuation stabilizing because bond yield is stabilizing, but the earnings is the part of the equity market that will take a hit next year.
Koku, thank you very much. Koku Angbibloa of Societe Generale. Good to see you. Thanks for spending time with us here on Bloomberg TV. Coming up on the program, we will talk to the Goldman economist Kevin Daly. He and the team have been setting their thoughts on the path to 2075. Yeah, not 2025, 2075. We'll get the long view. This is Bloomberg.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now, Goldman Sachs economists have taken up the daunting task of predicting the path of the world economy through 2075. Among the highlights, they see global growth on a declining path. I thought these were highlights, averaging just under 3% a year over the next decade. That's down from 3.6% in the decade before the financial crisis. Let's get other details now on this ambitious project. Kevin Daly joins us, co-head of CEMEA Economics at Goldman Sachs. That's Central, Eastern Europe, Middle East, Africa, and perhaps some other places beyond. Kevin, very nice to have you with us.
Good to see you, Anna.
So why 2075? Why embark on this project?
So, I mean, this is an extension of the original work by Jim O'Neill and team on the BRICS projections, which he first made 20 years ago with his colleagues. They originally projected out to 2050, and as it's close to 20 years on from those original projections, we thought we'd extend it further to see 50 years into the future.
Is declining population growth one of the biggest assumptions you make here, and one of the biggest pieces, one of the biggest assumptions that has an impact, I suppose, on where the future economy goes?
Absolutely. So one of the key themes, one of the key themes that you highlighted in the introduction is we do see slower growth over time. Most of that slowdown is driven by slower population growth. Population growth has already fallen from around 2% per year around 50 years ago to 1% per year now. The UN projects that it will fall to close to zero by 2075.
And even in some quite emerging markets, we're seeing population growth.
Well, China in particular, for instance, so you see quite a rapid slowdown now. Now, within the piece, we describe this as a so-called good problem to have, in as much as, for long-term environmental sustainability, we do need population control. But nevertheless, it will present some pretty challenging economic challenges for economies dealing with population aging, dealing with the slowdown in growth that involves.
Okay, Matt, jump in.
Well, it just shows you how quickly concerns can change, right? Because I remember, Bad Religion put out a song about 20 years ago called 10 in 2010. They were so worried about an explosion of population growth. And now we're worried about the opposite. Does this?
I wouldn't say I wouldn't say we're worried about it. I mean, I do think it, as I say, I do think it is a necessary evil in some sense over time that we do get population control, for environmental sustainability. What is interesting, though, is that not only are we seeing a slowdown in population growth, but actually the projections over time from the UN are also slowing. So they previously saw population rising to 11 billion by the end of this decade. Now they see it peaking at around 10 billion, and over time those projections are now declining.
This flies in the face, though, of my vision for the future, my Wall-E world vision, where the robots and the AI are doing all the work, so we humans just lounge around. The picture you're painting is more like one we're seeing in the JOLTS data, right? Where we have millions, maybe even tens of millions of job openings that can't be filled. Is that what we're looking at?
No, I should emphasize that this is that there is a lot. Wall-E, it was a great film, a somewhat dystopian vision of the future, though. So I'm not sure that's something we should be hoping for.
But the point being, the tech does all the work for us, Kevin, and you're saying that a slow labor force is a problem.
Yeah, but we do see productivity growth over time, and within any exercise such as this, we should emphasize the uncertainty inherent in any long-term prediction of this kind. One of the advantages, however, of making these long-term forecasts is that we exclude a lot of the cyclical uncertainty that we think about pretty much. In your show today, you've spent a lot of time talking about China, COVID reopening. That is, how China reopens to COVID. Whether that process goes well is critically important for next year's growth in China, but it's much less important for where GDP growth will be in 10 or 15 or 20 years' time. And that's one of the advantages of looking within this modeling at things like labor dynamics, capital dynamics, and productivity, which computerization and robotics will influence over time.
Well, let's go to that in our conversation then, because I started looking at what you're saying about population and then thought, well, do we need a new economic model here? Because if growth is driven by population increases or productivity growth, if we can't rely so much on the former, we have to rely a lot more on the latter. Is that what the next 25 years look like? And that's what people have to get right.
Yes, and productivity is always critical to growth. And some of the slowdown we've seen over the last 10 years, some of it has been due to population, but some has also been due to slower productivity. And one of the challenges that we face going forward, one of the key risks that we highlight within the piece is there is now a battle against globalization, resistance to globalization. We argue within the piece that globalization has been very good in terms of boosting EM income levels and therefore reducing global income inequality. But it probably has been associated as well with the rise of local inequality within nation inequality. And that has resulted in an understandable backlash against globalization, which policymakers need to address, need to focus on. And it is one of the risks going forward that this backlash against globalization, an increase in populism, an increase in localization will reduce trade and reduce productivity growth over time. But hopefully, we've been relatively cautious in our productivity assumptions within the model, so I think there are risks both to the upside and to the downside. But as a central case, we do see slightly slower productivity growth.
Okay, Kevin, thank you very much. Thanks for bringing us your analysis. Kevin Daly of Goldman Sachs, taking the long view. Now, coming up, how are the world's top money managers feeling about 2023? We touched on this story a couple of times already, but we'll get all the details. We have the latest Bloomberg survey. That's coming up next. This is Bloomberg.
Stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Kaylee Lyons is off today. Let's get a look at what's ahead. At 8:30 a.m., we're going to have the U.S. PPI reading for November, so one look at inflation. Then at 10 a.m., we'll have the U.S. wholesale inventories, or inventories, as you would say in England, as well as the University of Michigan Consumer Sentiment Surveys. They are some of the final pieces of data that the Fed officials will see before next week's December policy meeting. Anna?
That's okay. You don't need to speak English just for me. Now, the latest Bloomberg Fund Manager Survey shows optimism for the year ahead, but worries about stagflation. Some of the world's biggest investors predict that stocks will see low double-digit gains next year, which would bring relief after global equities suffered their worst, or look as if they're going to suffer their worst loss this year since 2008. Jan-Patrick Barnett joins us. He's been covering the details of this really interesting survey then of fund managers. JP, what is the general tone then that this survey reveals?
Well, I would say it's like cautiously optimistic or constructive view, if you want to put it that way. So 71% said that they believe the market will go higher next year. And then the 10% sounds nice. But if you keep this in context with like other rebounds in 2009, for example, or 2019, where stock markets rallied 30 and 20%, it seems rather modest. Also, we had like many participants in the survey saying like, well, we are bullish, but we believe that some of those gains are going to be rather skewed to the second half of the year. And they are predicting some wobbles in the first 2 quarters with the economy cooling and the path of inflation still a little bit unclear.
So, and this is a survey of a global survey, right, Jan-Patrick? Where do fund managers see the gains, or are they evenly spread throughout the earth?
Yeah, that's also interesting that when we asked like where they want to put the money, where their favorite spot is, so to speak, to put the money, most answers were rather defensive. So healthcare was named a lot. We saw a lot of dividend names and high quality stocks, basically everything that is able to defend a good balance sheet, to produce good returns, even with an economic slowdown. We asked about US tech. A majority said like they would still go back in, but not as in a broad approach, but rather be selective and make sure again here that you pick those growth companies and those tech companies that are able to produce good earnings even in a difficult environment. We also asked about China. Big majority here still wants to go back in, but many said like, let's wait a little bit and see how that COVID opening story is going to play out.
Okay, thanks very much. Jan-Patrick Barnett joining us there with the latest on what fund managers expect from the markets. He talked about COVID reopening. Interesting story just crossing the Bloomberg. Tesla to suspend output at its China factory later this month. Tesla will suspend output in stages at its Shanghai EV factory from the end of the month until as long as early January. This according to people familiar with the matter. We'll keep an eye on all things Tesla, all things Elon Musk, of course, for you. This is Bloomberg.
a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is like you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And like frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
We're in the early stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close. Welcome to Bloomberg Crypto.
We've never seen a recession so anticipated.
The first half of the year, we see all the signs of recession. And then the second half of 23 will be the markets then looking at 24.
The need to push financial conditions to a kind of tighter place again is going to dominate, and that's going to push the dollar stronger again.
That inflation-unemployment trade-off that the Fed has to deal with, they will settle for a higher rate of inflation.
The Fed's story is about over 2. They're just getting increasingly out of bounds.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. TK's been shadow banned. Got to work that out.
Maybe it'll be posted on his Twitter.
Going to talk about that later. Futures up on the S&P by about 0.4%. I feel like I've said this a million times. Looking ahead to next week,
I mean,
CPI on the Federal Reserve.
Although
coming up.
today perhaps gives some indication of what we're going to be looking for next week with the PPI coming up. It's the first of a couple key last data points before that December Fed meeting. So perhaps it will carry outsized import for a market that's kind of been meandering around some sort of theme.
Michael Hartner over at Bank of America, not just looking at the next meeting, looking at the next 3. He wrote the following: crashing oil says the Fed goes 50, 25, and then stops hiking. He says cooling housing says 50, 25, 25. And solid credit market says 50, 50, 25. And the hot labor market says they go 50 3 more times. I guess the question that Hartnett's asking over at Bank of America is, what is this Fed focusing more on? The earlier story, credit, what's happening with financial conditions, what's happening with crude, which has really collapsed, or what's happening with the hot labor market that says, go, 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 keep hiking?
And you can treat this with a bit of snark in that they've gone with a couple of the different metrics at different times when it's been convenient to fit a different narrative, right? So it's sort of unclear which one you're going to get. That said, they've been pretty persistent looking at the labor market. And yesterday we got Atlanta Fed wage tracker data that showed that actually wages ticked up in terms of how quickly they accelerated in recent readings, not what the Fed wants to be seeing. Either way, it seems like a 50 basis point rate hike seems to be the consensus. Everyone's going to say that's going to be the most important meeting until the next one and then the next
the one
one.
after that, and that's always the way, and it's the same with the CPI print as well.
Exactly.
Most important CPI print since the last one until the next one. On crude's negative on the year. Energy stocks are up by more than 50% on the S&P 500. Marko Kolanovic yesterday evening over at JP Morgan. We believe there is a tactical trade to sell energy stocks. I want to be clear here, long time still bullish the sector over at JP Morgan, but ultimately he says the following: an enormous gap has opened up between energy stocks and the price of energy commodities. He says this is a tactical sell in the equity market.
Interesting to me that he focuses on equities being too high, not oil prices being too low.
That's what Chris Verone said earlier this week.
Yes, and I really think about that, especially with China reopening. Why have we not seen a bigger move, especially as a number of analysts have come on and said that China's story has changed their overall expectation for next year and how quickly China will reopen. It seems like they are committed. It seems like they're laying the groundwork. And it seems like it's not just the protests, but also what's happening with the economy.
Just on China reopening, the latest reporting around Tesla just coming in. This, according to people familiar with the matter, Tesla will suspend output in stages at its Shanghai electric car factory from the end of the month until, Lisa, as long as early January. So this is two things. It's not just about slowing consumer demand. It's also production line upgrades. That reporting coming through in the last hour. The stock, Lisa, up by 0.4 in the pre-market.
Maybe also the founder of Tesla is perhaps a little distracted by other things and
Possibly.
maybe can't really get involved.
I want to
in
hear
this.
from the company now.
Yeah,
I've
look,
seen
that's
enough reports
why I'm
over the
saying
last
this,
week.
yeah.
I want to hear from the company and just to find out what's actually going on in China. We'll catch up with the Mercedes CEO a little bit later this morning. That's going to be pretty interesting.
Especially with respect to demand from China, not just really trying to manufacture things, but demand and how much they're feeling pressure from, just Western nations to move away from Chinese production and sales just because of some of the tensions.
Mercedes are cutting prices over there. That's been the latest shift. Matt Miller's going to join us as well, so looking forward to that conversation at about 8:15 Eastern Time. If you're just tuning in this morning, here's a flavour of the price action, a quick snapshot, sneak peek. Futures up by 0.4% on the S&P 500. Nasdaq futures up by 0.5%. In the FX market, euro dollar not doing much, 105.61. Treasury's basically unchanged on the day, unchanged on the week. On a 10-year, Lisa here, 348.15.
8:30 a.m. is what I'm watching, and it is the most PPI report that we're going to get until the next one and from the last one, and I'm looking at core. We saw a surprise deceleration in the producer price cap that we've seen, the producer price index. Do we see ongoing deceleration in core? Do we start to get a sense that we have already seen peak core inflation? And if that's the case, I don't think there's enough of a conversation around what the trajectory is from there. Is it a fast disinflationary kind of push, or is this a slow grind with a boomerang type effect underlying the index? Today, China's Xi Jinping will attend a China Gulf Cooperation Council conference as follows his meeting in Riyadh, Xi Jinping's meeting there. How much are we looking at laying the groundwork for a reopening? The Hang Seng China Enterprise Index saw a 29% rally in the month of November. It is the biggest going back to 2003, a rebound from really low rates. But the world is expecting them to reopen. How are they laying the groundwork from an industrial perspective? And at 10 a.m., they did not call John. The U.S. University of Michigan Sentiment Survey for the month of December. I know you always raise some issues with this, and I think you're right to do so, but partly because it tracks inversely the gasoline prices in the United States.
Sure.
And gasoline prices have come down dramatically to the lowest levels going back to January. Now do we see a boom in sentiment that gets reflected in extra spending, discretionary spending of the consumer? How does that play out in what people expect?
Well, if you call up 600 people on the phone...
800.
Is it 800? Is that the number? I don't know.
I'll check in the break.
However many it is, if you call them up on the phone in America, their view on inflation, looking out 5 years, is probably shaped by what's happening right now in front of them. And crude and gas prices is at the epicenter of that.
But you mentioned what happens 5 to 10 years out. And you have seen some sort of consistency over the past few reads. Does this give the Fed confidence, these 800 people, that perhaps these expectations aren't getting unmoored?
We'll leave that there. I don't have to break that number, I'm happy to say. That's not up to me. That happens at 10 a.m. Eastern Time. I'm gone. Mike McKee does all of that. Jose Rasco joins us now, CIO for the Americas at HSBC Private Banking and Wealth Management. Jose, fantastic to catch up with you, sir. I was just going through your notes. Underweight, global equities, a defensive tilt. I've heard this a lot, Jose. So I guess the question to ask you is what would make you shift from underweight to adding just a little bit more equity risk?
We expect to see a lot of volatility here as we reprice earnings for next year. I mean, remember, the economy is going to slow, and we're going to see continued disinflation, which means margins will get crimped. And as a result, we think we see another leg down here for equities in general, U.S. in particular. And when we see that re-rating of earnings for next year from 7% down towards 0, I think that's a point where we'd be interested in looking at U.S. equities in particular.
Jose, what's the biggest risk case for you? That we go into recession earlier or later than people currently expect?
I'd say later, because I think we want to get it over with, right? And look at the better growth prospects for 24. We have better economic growth, and we have continued disinflation. The potential the Fed could actually lower rates at some point in 24, right? And if you look at their prognostication, that's what they're suggesting. So we want to get it over with and start looking towards better growth and better earnings in 2024. That's our hope, yeah.
So this is the reason why it's sort of hard to understand how to trade data points as they come out. We have seen a softening in inflation, and suddenly people believe in a soft landing once again. Is the answer to that to buy risk assets, or is it the opposite? That the more that we prolong this sense of a recession, the harder the Fed has to go and the harder the landing?
Well, and don't forget, I would argue, everybody's so focused on the CPI. I think it's a bit of a red herring. I think you should really be looking at wages, right? Wages are growing in excess of 5%. In the last business cycle, they grew about 2.4%. That's the sticky number that needs to come down. Look at the latest railway deal we saw with the government. We're seeing some price hikes in labor markets still. The only thing that's going to get that down is a higher unemployment rate, right?
So, Jose, is that a Federal Reserve that needs to go even further? And how much upside risk do you think is there around the terminal rate relative to what's already priced?
Well, we've got them going 50 now in December, 50 in February, and another 25 in March. And we think that's about it. And that at that point, we think the Fed can take a pause, not a pivot. I want to make that clear, the wrong P word, pause. And we take a pause, look at what they've done, and then we reassess. But I think you'll see a slower economy clearly in 2024.
Away from the guesswork of the economy, if we get a recession, based on your understanding of this Fed's reaction function, do you believe that they won't cut interest rates?
They won't, you're saying?
Yes. Do you believe they will not cut interest rates in the face of a recession in America? Do you believe that?
Yeah, well, look, here's the thing. It's going to depend on the inflation data, heavily led by wages. And I think you will see some softening in wages as we go through the earlier parts of next year. So I think, remember, this year we had 27, 30 states raise the minimum wage in January. That was huge. It was the highest dollar amount and the highest percentage increase we've ever seen. So that was a big push up in wages. And I don't think we're going to see that COVID bounce back in the services sector as well, pushing lower wages up much higher.
Jose, I don't want to get into internecine battles, but we read the Stephen Major note recently about how 10-year yields are probably going to go down to 2.5% by the end of next year, that we're going back to the same kind of low inflation environment that we have become used to. Do you wager on that? Do you base your case on that? Do you load the boat with bonds in anticipation of that rally?
Well, yeah, we like bonds, and we like the short end of the curve in particular. I think if you look at the long end of the curve, it's going to continue to be well bid, right? Any kind of yields like we've been seeing, I think globally, don't forget, we have weakness in Europe. We have, struggling growth in parts of Asia. So I think, yeah, U.S. Treasuries will continue to remain well bid. Now, 2.5 to me directionally, it's more important directionally than it is the actual data point, right? And I think the long end of the curve remains well bid because of those factors, as well as a strong dollar. So yeah, that does make sense directionally for the 10-year.
Jose, wonderful to get your thoughts, as always. Jose Rasco there.
One final thing, Jonathan, if I could.
Maybe. I'll give you 20 seconds, Jose,
really
all right?
Quick. We haven't spoken in a while. Really quickly. Nearshoring. Keep an eye on the nearshoring theme, as that is something that's going to help, we think, propel economic activity in 23 and beyond. And it's a major shift in what's going on in Asia. It's a theme that we could investigate next time I come on, but I think definitely happening a lot quicker than people thought. A lot of foreign direct investment into Mexico.
That's the tease for the next appearance. Looking forward to the conversation. Jose Rasco of HSBC. It's been too long, sir. Thank you.
So generous.
Savita Subramanian of Bank of America agrees. This nearshoring thing, interesting theme. This is interesting too. Politico led with this moments ago. Senator Sinema is switching her party affiliation from Democrat to Independent. She says in an interview, quote, "I don't anticipate that anything will change about the Senate structure." That headline crossed just moments ago.
To me, the big takeaway politically from 2022 is a shift to the center. We saw that with the midterm elections, and we see that with a lot of who is winning, which type of candidates. How much is that really going to indicate who the candidates are going to be in 2024?
This is an important addition. She's not talking about whether she's running for election in 2024. I think that is an important line, Lisa, to your point.
Right. And if you aren't running again, does that give you more freedom to move away from the party structure in a way that maybe you wouldn't be able to if you were tied to it? Just saying.
Guess who's in town? AMH. She's here in New York City. She's going to join us next. Looking forward to that, to break this conversation down just a little bit more and dig in. And then later, Jeff Yu of BNY Mellon on this market. Futures right now, positive 1/3% on the S&P. In the bond market, yields basically unchanged. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with The First Word, I'm Lisa Mateo. Investors will be watching today's release of the U.S. Producer Price Index for clues on what the Federal Reserve may do next. The numbers come out at 8:30 New York time. The forecast for November says that inflation at the factory level fell from 8% to 7.2% over the previous 12 months. Fed policymakers meet on interest rates next week. Bloomberg's learned that the U.S. is preparing more sanctions on Russia and China for what it calls human rights abuses. The sanctions against Russia are expected to focus on its efforts to get weapons from countries such as Iran, especially drones. The penalties against China will center on its fishing industry. And China faces a daunting task after abruptly giving up on COVID-0. The number of infections is expected to soar, and deaths are predicted to rise above 2 million. The U.S. and Europe had an ebb and flow pattern of outbreaks over months and years, but China is likely to see a wave of infections hit the country all at once. The International Monetary Fund, World Bank, and others are sounding the alarm about a worsening global outlook. Speaking in China, IMF Managing Director Kristalina Georgieva says indicators show further downgrades to global growth are likely, but she's hopeful that China's reopening will help the global economy. And Elon Musk says Twitter is working on a software update to let you know if your posts have been suppressed on the platform, the reason why, and how to appeal. The announcement follows a Twitter thread by a journalist with access to company documents who said that conservative commentators had their tweets downplayed by employees or shadow banned. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. It's a big week for the U.S. economy, and Bloomberg's got you covered.
My head's spinning here.
First, on Tuesday morning, CPI data comes in.
We're seeing things work themselves out.
This is going to be a really choppy ride.
Then on Wednesday afternoon, a special surveillance will cover the Fed's last rate decision of the year.
Power of that Fed speak is declining.
Does this Federal Reserve have the commitment to keep going?
The question is, how high do they have to go?
The CPI report Tuesday morning and the Fed decision Wednesday afternoon. Right here on Bloomberg, your global business authority.
Mr. Putin has proven he's not willing to sit down and negotiate an end to the war in Ukraine. President Zelensky has said that while he does want eventually to get to a negotiated settlement, now's not the time for him either. Mr. Putin continues to kill Ukrainians. He continues to strike civilian infrastructure. He continues to try to weaponize weather itself. And what we're going to do is stay focused on making sure that the Ukrainians can defend themselves against these threats.
John Kirby there, the coordinator for strategic communications at the National Security Council, weighing in the last 24 hours. From New York City, good morning to you. Here's the price action on the S&P 500 this Friday morning. Going into a little bit data a little bit later on this morning. We get you, Mitch, some PPI data, 8:30 Eastern. I'm sure you're excited about that. Futures up by 1/3% on the S&P. Yields unchanged on a 10-year, 349. The latest reporting coming from Senator Sinema saying she is switching her party affiliation from Democratic to independent. She says the change is, quote, to give a stronger voice to Arizonans who value lasting solutions over partisan politics. Sinema declares her independence from the broken partisan system in Washington. Lisa, she says she's switching party affiliation, but she won't caucus with the Republicans.
Unclear what this means in terms of the balance of votes. Also, though, will she run for re-election? Do you need the party system to back you if you hope to get elected, or can you run effectively as an independent and actually win?
In New York City, I'm happy to say. AMA's dropping by. Anne-Marie, good morning to you.
Good morning, guys.
Good to have you with us. What do you make of this?
Well, I think given the fact that have you seen her work across party lines a lot over the course of the past year especially, I mean, the reason why we don't have really the carried interest closing that loophole was because of Senator Sinema. It's not great for the Democrats in the sense that, as the political reporting called it, neat and tidy of the 51 seats, but doesn't look like she's going to be changing how she conducts business on the floor. We also have an independent when it comes to Senator Sanders, and he pretty much always obviously votes with the Democrats. But it's a little bit of a blow, right? Because I thought they gained this extra seat. Now she's saying, potentially, this means she's going to lean a little bit more into some of that Republican caucusing.
Am I getting a little carried away here by saying that there has been a huge shift to the center in a way that we haven't seen for years with respect to the midterm elections and with respect to what kind of bipartisan work has gotten done?
I think you can point to that depending on the issue. At the moment, look what we have going to the president's desk, the same-sex marriage bill. More than 24 Republicans voted for that in the House. Then we have the defense spending bill. What you have is Democrats had to say, fine, we're going to give in to the Republicans, and this, what they want is a renegade on the fact that the military has this coronavirus mandate for troops. You have to get that done. Democrats don't want to do it, but they had to do it to get the spending bill done for the defense spending bill. So you have a number of issues where they've had to come to the middle, and Republicans are realizing that because it wasn't the red wave, and the Democrats are realizing that because they still have control of the House going into next year, and they still have legislative agenda they want.
But could someone actually win a major election without the political party instrument behind them?
Major political
party,
election? Yeah. Well, you mean an independent winning a president? Well, there's been reporting that there's individuals like Senator Manchin who's thinking about this third party, but we've seen this play out for decades in America, and it's never taken off. Because how do you have the money go to a third party? It just would not happen.
Can you imagine if the former president made a run as a third-party candidate? That would complicate things in a big, big way for these Republicans.
It would complicate things, but also, again, I look to the money factor.
Sure, good point.
He gets the money in that and spending from really tiny nominal capital donations from a large group of people. You're not going to have the big Wall Street titans going behind him, especially not as an independent.
Just responding to the story of the last 20 minutes or so, Senator Sinema of Arizona says she's switching to independent. The story of the last 24 hours, a controversial prisoner swap. Where are we on day 2 of this?
Well, Brittany Griner does look like she is back in the United States. What I would say is that this has been welcomed in Washington. Everyone wanted Brittany Griner home, but it hasn't come without questions on why Paul Whelan, the former U.S. Marine, is still left behind. And that's how he feels in this interview he gave to CNN. And it's the Republicans, but also some Democrats. And I just want to bring you a quick quote from Bob Menendez. He's a Democrat. He's obviously the chairman of the Senate Foreign Relations Committee. He said, this should be a moment of deep reflection for the U.S. government to recognize we have a serious problem with hostage taking. And he says we cannot ignore the release that Victor Bout, who is this merchant of arms, this individual is now back in Russia territory.
How much pushback is there that Victor Bout is still a dangerous individual and is wanted by Russia to help with illicit dealing of arms? He helped supply a whole host of conflicts all over the world that were really antithetical to what the U.S. was trying to do. How concerned are people who spent years trying to prosecute him?
Well, there's a number of people who actually look at this and they're like, he's kind of a bit of a headache for Putin now that he's back in Russia. Because they're not going to have him go around the world trying to, conduct arms sales. It was embarrassing for Putin when he was arrested. So he'll probably just kind of be put to the wayside back in Russia, and that'll be it. He'll just be living there out his life, and I don't see him traveling around the world. Do the Russians even want him back at this point? Some are even questioning.
Well, clearly they do. Otherwise, the prisoner swap wouldn't have happened, surely.
Well, yeah, but at the same point, though, the United States is making tons of noise about Brittany Griner. For the Russians, some would say that even became a little bit of a headache, right? The Russians are focused on other things as well. They want to make sure they have the oil and gas that can continue to ship, and that they also want to get their fertilizer out in the open market.
So I think we can all process 2 ideas at the same time. Overwhelmingly, people are happy that this individual has returned, an American citizen, back to America. Overwhelmingly. There is just a feeling that this exchange is very lopsided. Isn't that ultimately the criticism coming from all corners?
Yes, it's coming from the Republicans, it's coming from the Democrats. They do feel like it's lopsided. The United States traded as an athlete for an arms dealer, and that's how it is being viewed in Washington. And what many are saying, if we were going to give back Victor Bout, who is this incredibly dangerous individual, was serving a 25-year sentence in the United States. He was selling arms to terrorist groups that had targets on American backs. Why did we also not get Paul Whelan? That's really what it comes down to. And then, of course, there's a ton of pressure in the administration now to bring back Paul Whelan, even more so now. And who is going to be that trade?
Meanwhile, as we talk about this prisoner swap that is controversial, we're also talking about a significant increase in national defense spending that is getting passed. And I think it's something like more than
$45 billion more than the president wanted.
So what does this tell us about where these tensions are, not just in Russia, but also in China, and how the U.S. is trying to arm up for it?
Well, I think first thing it tells you, too, is that this is a Democrat-controlled, at the moment still, Senate, House, and White House, and you have a massive defense spending bill. $800 million of that is going to Ukraine. There's much more money going to Taiwan. And, of course, this has to come down to competing and defending with China. Also interesting in it, and we talked about this the other day, it's out also that the U.S. military or anything that's part of national security companies that use semiconductor chips cannot get those from China. So it's not just about, 11 naval ships instead of 9. There's also a lot of technological provisions in this as well.
Are you sticking around for World Cup coverage a little bit later with Tadeo?
Yeah, and we're going to your house for the World Cup. Are you coming, Lisa? We're going for the France-England game.
Canzaferro, there is a viewing party. TK's very upset he didn't get the invite, AMH, so keep this down.
Yeah, exactly. Well,
I'm in his seat today.
He's celebrating his birthday, so we will wish him that.
We will, let's just pause on that. We'll do birthday wishes in the next
I hope he's in Paris for his birthday.
He's not. I can tell you he's not. I can tell you he's really not.
Oui, baguette.
AMH, good to catch up, as always. Here's the price action for you going into the final trading day of the week and going into a defining week next week. The Federal Reserve decision just around the corner. CPI as well. Yields unchanged on a 10-year, 348.87. In the FX market, euro dollar 105.52. In the equity market, we are firmer by about 1/3 of 1% on the S&P 500. Up on the session, but down on the week. Crude up on the day, down on the year. This is ridiculous. 71.89 on WTI crude with positive 0.6 of 1%. And as I mentioned a little bit earlier, a monster gap has opened up between what the commodity is doing, oil, and what the equity is doing, energy names. Energy names are still flying year to date. And JP Morgan, Marko Kolanovic out yesterday evening, Bramo, basically saying there's a short-term sell in the mix here, and he's selling the energy names.
Yeah, well, I wonder if the U.S. government's going to be buying. We're going to get to that point.
Buying crude?
Yeah, I'm looking at this. I don't know.
Freya Beamish up next from TS Lombard.
I started, I had no idea it was going to turn into this. Just a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
As things stand, the equity market on the S&P 500 heading for its biggest weekly loss, going all the way back to the start of November. Equities right now positive, trying to eat away at some of that, up by 1/3 of 1%. On the Nasdaq 100, up by about 1/2 of 1%. In the bond market, 2s, 10s and 30s shaping up as follows. On a 2-year, down a couple of basis points to 4.28%. On a 10-year, just south of 350 at 348.51. Yields there totally unchanged. In the FX market, just want to get to the euro. We talk a lot about the Fed. It's still the ECB next week. Euro dollar right now, 105.58. Also totally unchanged there as well. Do you want to hear what consensus looks like? Consensus sounds a little bit like what we heard yesterday from Mr. David Balin over at Citi. Take a listen to what David Balin had to say.
It's going to be a tale of two halves. Markets lead the economy. And what they're telling us is that next year, the first half of next year is going to be a difficult period, both in the U.S. and in Europe. The second half of 23 will be the markets then looking at 24, looking at a recovery from whatever recession it is that we're going to have.
You bored of hearing this yet? How many times have we heard that?
I mean, this is the consensus right now. And
overwhelmingly.
I mean, even Anastasia Amoroso said, yeah, I'm on board with consensus. It's not comfortable, but it seems like a plausible story. The problem that we've been talking about is that why sell if you think that everything's just going to rally after a brief pause? How much does that support the market and keep it going for longer? And Jose Rasco, I thought this was really interesting, of HSBC. What's the bigger risk? The bigger risk is that we don't get a recession, in his view, at least to stocks, at least not now, because that means that it will be a harder landing when it does come.
Well, Savita Subramanian thinks the other way, that if that recession gets delayed, ultimately, the biggest risk is not owning equity risk going into 2023. And that could be a big, big issue for a lot of people who are just sitting there waiting for the middle of next year to say bye, bye, bye.
Does that mean that you don't get a recession, right? Or does that just mean that it's a tactical kind of feel for the beginning of next year? I mean, this is what we were hearing from a whole host of different individuals, including Alessio De Longus, saying that he actually thinks that he's bullish on stocks in the beginning of the year, but that's a bad thing for later on in terms of returns. A very nuanced moment.
Here's a quote for you. The US recession is a popular forecast simply because it is hard to bet against the Fed, but Chair Powell has now turned from Volcker impersonation to cakeism. Freya Beamish joins us right now, Chief Economist at TS Lombard. Freya, they're your words. What on earth is cakeism?
Yeah, well, I think that might have been my colleague Steve Blitz, just to give due credit there. But cakeism is something we use quite a lot because there's a lot of it out there. It's when you want to have your cake and eat it, essentially, and the Fed doesn't want to actually grasp the nettle and tighten financial conditions to the extent that would be necessary to really kind of guarantee that recession coming through. And they don't say they want a recession, but they need to get the below trend growth in their paradigm and way of doing things. And it really sort of speaks to the kind of two scenarios that you can see for next year that hinge on what the Fed is going to do. You can either get a sort of a purgatory where some of the dynamic from 2022 carries over into 2023, or you can get this sort of last hurrah the kind of dynamics that prevailed in the kind of pre-COVID world, coming back and giving us this period where you get the tactical buy before you get a sort of a phase two of what we've seen in 2022. Which is essentially a rebalancing of financial wealth into line with the real economy. So sort of no matter what scenario happens in 2023, what we think is that investors should be using it to position for the bigger picture that is coming after that, which is one of higher inflation in the kind of 2020. So we're talking not getting back to the 2%, maybe 3% or higher. Higher growth and therefore higher yields, especially when you add in the greater uncertainty that we're all facing in the kind of deteriorated geopolitical and natural environment that is the reality of today. So that all means higher yields and lower valuations is where we're still going to end up in the rest of the 2020s. But in 2023, there's this sort of kind of limbo era where it's not really clear what's going to happen. And there is this consensus that there'll just be a recession and then you buy and then everything's going to be okay because it's not going to be that much of a deep recession. And I think, it's easy to buy into that. There's nothing to say that there's going to be a persistent recession in the US, particularly because the liability side of the balance sheet just doesn't give any reason for persistence of the kind of the weakness in the economy. But I think the purgatory argument is more that the Fed goes 50 this month. And that means that this is it for financial conditions. And then you perhaps get inflation coming back down. So 3-month annualized rates of core inflation could come back down to 4% by Q2 of next year. And then the Fed does actually look quite tight if they get to their 5% by some people's standards. But it's really about sort of like the speed of the adjustment that they've made rather than the level of rates that they've really reached for taking this from a long-term perspective. And so if you kind of are waiting for these cumulative effects to come through and to slow the economy down, then they probably do come through. But that's really just a symptom of how rapidly things have turned around rather than anything that sort of persists. So you get this period where everyone kind of thinks everything is okay, and it almost feels like a kind of a soft landing because the Fed all of a sudden looks tight and inflation is coming back down, the economy is slowing. But actually underneath it all, what we've called this, we're saying it's a sort of a mirage of disinflation, because if that does happen, then growth will pick back up again, and inflation will rebound, and it won't look as happy by the end of the year.
The boomerang inflation. I was thinking about this last night, and I got to say, for all the people who think I'm really gloomy, what you just put out there, Freya, really highlights the concern of a lost decade or a stagflationary decade in the United States. Is that basically what you're talking about with meandering returns from both stocks and bonds?
I think it's going to be a very difficult environment, and it's kind of strange because I think what's happening is we're going from a low returns economy to a high returns economy. But the process of getting there is really unpleasant. And there are all of these different kind of major global political economy secular forces that are pointing towards probably higher inflation, part of that being cost push inflation as a result of deterioration of the geopolitical and natural environment. So there's greater likelihood of negative supply shocks injecting inflation into the economy and destroying demand. That's definitely stagflationary, bad for bonds, bad for equities. There's also the China slowdown. So all the economies that are exposed to that, particularly Euro area, EMs, commodity facing economies, these guys have this drag to contend with that China is slowing and the growth model is broken. But we do see some kind of more positive aspects in the sense that potentially if you do get this transition of wage growth back towards developed markets, because we think that China is no longer a constraint on wage growth in developed markets anymore, and you have the potential for credit growth to pick up again, then you've got your demand drivers coming back. And when that happens, funnily enough, productivity growth probably turns around as well. So you've got productivity growth, you've got wage-driven income, and you've got debt fueling income as well. So that sounds like you should get higher real growth as well as high inflation. I'm talking about primarily the US economy here, but even the UK could have a little bit of that. Let's not be too completely out and out gloomy on the UK economy. But what that means is you're going to higher yields. So if you think about if you kind of decompose that into what it means for yields, bond investors are never fully compensated for real growth. So let's say 2% growth, so it's a long-term forecast, so who really knows? Let's say half of that is compensation for bond investors, and then 3% inflation plus term premia have to open up again because of this greater uncertainty. And so you're easily at 5% for the 10-year. For the US over the 2020s. And so that is a massive hill for asset prices to climb, higher yields, lower valuations, which makes sense in the geopolitical environment that we're going to as well. So actually getting to that environment is very difficult. And what you want to do is get exposure to the real economy, to get exposure to tangibles, to get exposure to the suppliers of supply, as in capital goods, as this supply-demand mismatch is being brought back into line slowly, painfully over time. It's difficult for asset prices, but it's maybe a good thing for the real economy.
Just real quick here, how much pushback do you get from this scenario?
Quite a lot, because it's very gloomy and people want to know. That's why I'm saying kind of where do you try and get the exposure in the shorter term. So there is pushback there. But it's, there is such a kind of cozy consensus over the course of this year that, you're trying to find these kind of different scenarios that really kind of push back against the pushback.
Hey, Freya. Fantastic to have you on the show. Thank you. Freya Beamish there.
Thanks for your time.
TS Lombard, thank you for your time. Let's talk about inflation next week. The estimates so far, we get PPI a little bit later this morning, then it's on to Tuesday, December 13th. CPI, we're looking for month-over-month headline inflation to come down to 0.3% from 0.4%. Core, stripping out food and energy, in line with the previous month. That's the estimate so far in our survey of 0.3%. If you want a better headline number, we're set to get one year over year. We're looking for headline to drop from 7.7 to 7.3, and core year over year, Lisa, going into next week. The survey so far indicating we drop from 6.3 to 6.1.
How do you trade this? If it comes in hotter than expected, how do you trade that? If it comes in lighter than expected, how do you trade that? It depends on what the underlying components are. Is it driven by goods disinflation? Do we still see that services component picking back up? That's all going to matter. The nuances at this point matter. Perhaps Fed Chair Jay Powell shouldn't say that, but the nuances matter under the surface, at least for people who are in the markets.
Anna Zentner at Morgan Stanley says the following: continued core goods deflation and decelerating shelter inflation should see core prices confirm the October signal of a turn in the inflation data. And to your point on a nuanced Chair Powell, will we get a nuanced Chair Powell in the news conference? Because Jackson Hole was pretty blunt. The last news conference was pretty blunt. Then Brookings was on the one hand this, on the other hand that. Bit of nuance here, bit of nuance there. And very academic. I thought very, very academic. Maybe that was just the forum at Brookings last week.
The amount of pushback that he's getting from both sides of the aisle in terms of perhaps using a blunt instrument to deal with inflation that is multifaceted is vast. I mean, really, he is getting so much pushback. There are a lot of people who are saying disinflation is here. We are going to see a rapid decline in inflation, and actually we could end up with an even lower inflation rate in the future. A lot of people disagree. That boomerang kind of idea that Freya Beamish was talking about is still very much present on the other side, but he's trying to cater to both sides. And can he get what he wants if the market keeps easing in terms of financial conditions?
Cakeism. Do you like that?
Happy birthday, cakeism.
Kathy Jones at Charles Schwab in the next hour. Looking forward to that around 7:30 Eastern time. She has thoughts on this Federal Reserve. Equity futures up 1/3% on the S&P. We are positive on the session. We are down on the week. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A surprise from Capitol Hill today. Arizona Senator Kyrsten Sinema tells Politico and CNN she is changing her affiliation from Democratic to Independent. That will make the Democrats' narrow majority more complicated. Sinema says she will not caucus with Republicans and indicates she'll keep voting the way she's done her first 4 years in the Senate. Traders are awaiting inflation figures that may give them an idea on whether the Fed will be able to ratchet down its rate hike campaign. The U.S. Producer Price Index, it comes out at 8:30 New York time. It's one of the final pieces of data Fed policymakers will see before their meeting next week. The U.S. is sending another $275 million in military aid to Ukraine. It includes ammunition from the rocket system known as HIMARS, along with high-tech systems that can detect and counter drones. The amount is smaller than other recent packages the U.S. has sent. Military officials are predicting a slowdown in fighting between Ukraine and Russia over the winter. China's President Xi Jinping says that Beijing is willing to expand its oil trade with Saudi Arabia. Xi is on a visit to the kingdom that reinforced ties between the world's #2 economy and its top oil exporter. Xi and Crown Prince Mohammed bin Salman also agreed to hold summits every 2 years. And Microsoft says it will address concerns that U.S. regulators have about its $69 billion takeover of Activision Blizzard. The Federal Trade Commission is seeking to block the deal. It says the tie-up between the Xbox maker and the popular video game publisher would hurt competition. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
I think you're starting to see a bit of a demand issue in China. And that's something that I think Tesla's adjusting to. I still view it more near term, not a long-term systemic issue. But look, after a Cinderella story, that they're starting to clearly hit some hurdles in China. But our thesis for 23 in terms of 2 million units globally continues to stand.
That was Dan Ives of Wedbush. The latest reporting coming from the team here at Bloomberg that Tesla will suspend output in stages at its Shanghai electric car factory from the end of the month until as long as early January. This according to people familiar with the matter. Two reasons for this: production line upgrades and slowing consumer demand. Let's get into it with Craig Trudell, who leads Bloomberg's global automotive coverage. Craig, can we just start with the latest reporting? What are you learning from what's going on over in Shanghai?
Yeah, so as you mentioned, a staged suspension of production toward the end of the year, and also looking into 2023, also the Chinese New Year, potentially also some production going down for that as well. I think this is absolutely an issue affecting Tesla, but the industry broadly. We spent some time this week with Bentley here in the UK talking about really around the world a strong order flow, with the stark exception being China and the effect that the lockdowns are having. This is something that's hitting the industry broadly. That's also something that we saw, show up in the industry data reported this past week, that the month of November was a bit weak. I think with the electric vehicle sector also there's a sort of cloud hanging over for 2023 in the sense that there's some government incentives that will fall by the wayside unless there's a policy change. So that's also another sort of factor to consider when you look at Tesla specifically.
Craig, are auto manufacturers rethinking how much traction they can actually get in China just due to the competition and due to the preference of national models?
I think it's sort of an underappreciated story. Just the amount of success that the domestic players are having in China. They're really dominating the electric vehicle space. So you're seeing BYD in particular get an awful lot of headlines with the success that they're having, and really challenging Tesla for the lead in terms of pure electric vehicle sales, and also kind of turning their sights for exports. So this is increasingly going to be a story of real challenges for the established car makers, the global car makers like Volkswagen and General Motors, who for a long time have had real success in the China market. But it's also going to be more global, where we'll see companies like BYD really sort of flex their muscles in other parts of the world.
Craig, I'm really glad we have you on today, because there's a story of nearshoring or onshoring that's been going on. We talked yesterday with Dan Ives. He said the Tesla story is specific to Tesla. You're basically saying it's probably a bit of a broader story. How much under the hood, so to speak, are a lot of these car manufacturers bringing production back to the nation where they're headquartered, or at least nearby? How much are they doing that in stealth so as not to anger the Chinese government?
I think we're going to see a huge inflow of investment in the U.S. as a result of the Inflation Reduction Act. I think there's a lot of attention on whether or not electric vehicles are going to be eligible for incentives, and whether it's $7,500 or $3,750. Maybe what sort of gets missed is the amount of support that is within that bill for battery assembly, and the real sort of effort being put forth to pull some of the battery and battery supply chain from China and localize it in the U.S. You've seen, a lot of also negative headlines of, whether it's South Korea, Japan, Europe, being concerned about what the U.S. is doing. But that I think that's a reflection of just how good the incentives are, and just how much, we're going to see battery investment shift, even from places like here in Europe, where uptake has been, faster. The U.S. is really getting aggressive in trying to attract investment, and we're going to see, companies kind of, march their investment dollars to the U.S., to answer the call.
Craig, which companies do you think, particularly in Europe, because BMW already has a massive presence here in the United States, who are you looking at?
Yeah, I mean, one company that's going to be really interesting is Northvolt. So they are backed by BMW, backed by Volkswagen, had a plant planned for Germany that just in the last few weeks they've talked about the idea of, well, maybe we need to put this plant on ice and put it aside and really turn our attention over to the U.S. And that's a result of the fact that, the incentives for cell investment and manufacturing in the U.S. is potentially going to make the U.S. the most profitable place to make batteries in the world, according to a very in-depth UBS report just in the last few months. So,
do the Europeans have a plan to deal with that, Craig? Do you think they've got a plan to counter that?
I think that was something that came out of the meeting with Macron and Biden. Obviously there was an attempt to on the part of the French to get this addressed, and the sort of retort on the part of Washington is really the belief that you will have to do this as well. You'll have to support battery investment, and I think we've of course seen efforts by the EU to really generate investment in the battery supply chain, but that's been undercut lately by the price of energy. This is a very energy-intensive industry, and it's something that we've heard Northvolt cite as a reason, in addition to the IRA, that investing in Germany right now perhaps doesn't make as much sense as it did 6 months or a year ago.
Craig, we'll catch up with the Mercedes chief in about an hour from now. What do you want to hear from that company?
How they're going to succeed in terms of real scale with their electric vehicles. They have some really exciting product, but it's at this point really at the high end. So I think we've seen some success in terms of good reviews and good feedback in terms of their initial efforts to really put their full foot forward in terms of early EV products. But when are they going to get to a point where Of course, Mercedes is not going to play down in the $30,000, $40,000 range, but even $50,000, $60,000 and really sort of start to get some volume and challenge companies like Tesla from that perspective.
Craig, wonderful to catch up. Craig Trudeau there on Tesla as they suspend output in stages at its Shanghai electric car factory from the end of the month until as long as early January. The two reasons, and we got into it a little bit there, Lisa, production line upgrades and slowing consumer demand. I imagine how much of it is the former and how much of it is the latter. I think we need to get our hands around that.
Well, a recent producer, and I know that this isn't in the auto space, in the car maker space, but we saw with Apple that it was really the demand side that a lot of their suppliers are worried about in China, not necessarily just even being able to create the iPhone. It's actually people aren't buying things because they aren't getting money and they aren't moving around and they've been locked down for a couple of years.
Talked about tension between Europe and the United States a few times over the last few weeks, particularly when the French leader came over for their state visit with the President of the United States. There's real tension over this, over the auto production story, over the Inflation Reduction Act, the subsidies, the credits you get, the fact that the Europeans are probably, these big manufacturers are probably going to invest even more in America now to produce here.
In all fairness, it's not just a subsidy issue. It is also, as Craig was talking about, an energy cost issue. It costs a lot more to do production, to make some of these industrial goods in Europe right now, in Germany. What does this mean for the industrial future of Germany if not only are they getting slammed with U.S. competition, but also because you're hearing about factories idling production lines in order to reduce their energy bills because they cannot cope. And that doesn't seem like it's something that's going to go away, even as a variable, simply because where is that natural gas going to come from? And that is the primary source of energy.
It was the first thing today. Messaged me yesterday. Winter's arrived in Europe. That conversation that we started to have around the summer about maybe rolling blackouts, shutdowns, industry shutdowns, Germany, maybe even spreading across Europe, that kind of faded when we started to get the mild weather back on the table. Matt Miller's been talking about it over the last couple of days, and it's going to be interesting to see what the Mercedes chief's got to say about it in about an hour from now.
What's the calculus in terms of when to shut off factories? How quickly can you bring it online? And what's it worth in terms of subsidizing production now to keep a toehold in an industry that's getting increasingly competitive? This is a really massive issue, especially with the subsidies also coming online in the U.S.
I don't think anyone thinks Europe's out of the woods.
No.
You get through this winter, great. Can you repeat the act next year? I've asked that question a million times.
You say no one thinks that they're out of the woods, but that's one consensus for next year is to go into European equities because they've gotten so beaten up. Some people are saying it's actually time for them to do better. You've seen people go into the euro rather than the dollar because they're expecting the Eurozone to...
Well, China's a reopening story is a factor in that
but it's
too.
all going to be a perfect storm. But China reopening is going to increase demand for liquefied natural gas, and it's going to only increase some of these production costs in Europe. It is a complicated picture.
Look, I think we all hope that Europe comes out the other side of this
of course
earlier than we anticipated. That's not a market call. That's just a call in basic humanity. Just to get out the other side of this and have a better European economy is good for everyone, surely.
Existential Friday.
Is that what that is?
Just let's all get to the other side of this, whatever this is.
Then we all need to get to the other side of this week and this year, that's for sure. Jeff Yu of BNY Mellon's going to join us shortly. Looking forward to that conversation. Live from New York City this morning. Good morning to you. Futures positive 1/3% on the S&P. With Lisa Brabbits, I'm Jonathan Ferro from New York. This is Bloomberg. You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
We're in the early stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority. The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
We've never seen a recession so anticipated.
The first half of the year, we see all the signs of recession. And then the second half of 23 will be the markets then looking at 24.
The need to push financial conditions to a kind of tighter place again is going to dominate, and that's going to push the dollar stronger again.
That inflation-unemployment trade-off that the Fed has to deal with, they will settle for a higher rate of inflation.
The Fed's story is about over 2. They're just getting increasingly out of bounds.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz. I'm Jonathan Farrow. Jeff Yu of BNY Mellon in the building. We'll get to him in just a moment. Equity futures right now up 1/3 of 1% on the S&P 500. Bramo, you know what it's all about. It's the drumbeat. The drumbeat grows louder into next week.
The drumbeat to CPI and then the drumbeat to the Fed. We haven't talked enough about the Fed's projections.
And the plane back to London just to get home for Christmas.
Yeah, exactly. I was about to say, are you really talking about that? The drumbeat. It's not the drumbeat to PPI, not at all. Or drumbeat to CPI. I don't think you're alone. I think this has been a truly exhausting year for so many people, which is the reason why everyone's not even trying to give a narrative to the recent price action. They're just sort of like, yeah, we're trying to figure out next year, and everyone's locking up their books.
23, big dip, then we rip. Isn't it? Isn't that right? Isn't that 2023?
Is that the rhyme? That's what people think, yeah.
Then we rip.
Exactly.
That's it.
Do you buy it?
It's not for me to buy. I just know a lot of people are selling it right now. I hear it all the time.
It makes sense. You can understand that people think that next year we're going to get the earnings, you're going to see margin compression, and then the Fed's going to stop hiking, and then everything's going to go back to normal. I think transitory never died. I think we're going back to this disinflationary feel.
I keep hearing the same thing.
For me.
Inflation's going to dissipate quickly, and the Fed's going to back away. Leadership back to tech.
Can I just point out?
Pandemic, pre-pandemic playbook hasn't changed.
And Freya Bayish was saying the same thing. And then I said, you know, how much pushback do you get? And she said, no one likes gloom, which is perhaps the tenor of some of the hate mail that I
just
occasionally
struggle
get.
with blowing up a decade's worth of QE and low interest rates, and all we get is what, a 20% move on the S&P, and we move on with life. That's it. You blow up like a massive chapter of economic history, and the price of that is 20% on the S&P. Is that right? Is that what we're being told? Essentially, right? That's it.
Jeremy Stein, who is formerly on the board of governors at the Federal Reserve, he's currently a Harvard professor. He came out yesterday and he said it's just so amazing that the Fed was able to disinflate an asset bubble without causing a financial crisis. And the response to that has resoundingly been like, oh my goodness, now look what you're going to do.
I'm not saying there will be one.
This is
I think
famous last
you know,
words.
let's have some humility about where this is ultimately going. I've got no idea, and neither's he.
Well, I think that a lot of people are saying we're humble, we don't know, but we're going to bet on what we do know and what we know from the recent past, which is typically the Fed rides to the rescue, and that we're going to head back to what we know because we have an aged population and plug in the whole narrative here.
Sure.
The pushback to that with onshoring, with an aging population, with labor shortages, with some of the transformation in the economy, with the real world kind of revenging itself and causing real materials to go up, kind of create a little bit more of a difficult logical scenario there.
I'm with TK. I'm in cash waiting for June 1st.
Is that so?
Yeah, June 1st. First, because first half dip and then second half rib.
Okay.
It's that simple. Next year, I'm told. 23, June 1st. Just buy.
What denomination is that cash going to be in?
Dollars. I mean, we're funded in dollars.
We're?
You know, me and Tom.
Faro Capital.
We pull our assets.
Faro King
Equities
Capital.
look like this morning. Good morning to you. We're up a third of 1% on the S&P 500. In the bond market, yields essentially unchanged on a 10-year. We are at 348.33. Euro dollar here, Lisa, 105.59.
Today, it is drumbeat to the CPI with U.S. PPI producer prices. How much do they decelerate? We saw a surprisingly large deceleration in the previous read. I'm looking at core. Strip out energy, strip out food. How much are you seeing some of the goods disinflation continue to accelerate? And really, is this a head fake? I keep thinking about that. Is this a head fake because when things are cheaper, people buy more, and then all of a sudden you've got more money in the system, et cetera? I know, I'm painting this in a negative way, but that's my question. Today, China's Xi Jinping will attend a China Gulf Cooperation Council conference. Curious to hear what we hear about the reopening, because the market is buying in. The Hang Seng China Enterprises Index had its biggest monthly gain in November, going back to 2003. The market is moving as if China were going to reopen. How much does Xi Jinping lay the groundwork for that? And at 10 a.m., after 600 people, or at least, are surveyed, U.S. University of Michigan Sentiment Survey comes out. How much does it track inversely, the decline that we've seen in gasoline prices? I did look at some of the internal dynamics of that survey, John.
Sure, and what did you learn?
It's at least 600 respondents.
Yeah.
There are 420 cases for the preliminary reading.
Cool.
And it asks things, about how you're feeling.
How you feeling?
Yeah, it's
Where's
random
inflation
sampling
in 5 years?
of cell phones around the country.
It's great. Jeff Yu joins us now, senior strategist at BNY Mellon. No secret that one of my favourite foreign exchange guests for the best part of a decade plus in London is Jeff. Jeff, it's great to see you.
Likewise, pleasure to be here.
The title of your outlook, Stepping Back from the Brink. Is that what we're doing?
Oh, we are stepping back from the brink, and as you mentioned, it's amazing that we're not falling, and stepping back, given the amount of tightening that's gone through. And heading into next year, the general view is probably every reason to be slightly hopeful as well, especially with the China news coming through.
500 basis points of tightening within a year. What is it, 9 months worth, 10, 11, whatever it is, Jeff. That hasn't hit yet. What's the price we've got to pay for that?
Yeah, but it's 500 basis points of tightening against how much in leverage, right? How much in terms of shadow leverage? Where was the financial system in 2008, 2009? Where's the financial system now? And one key word here, regulation. Where was regulation, or where should it have been heading into the GFC, and where is it now? So I think, those are the things which, on the upside, you could say it inhibited any potential rallies. For the downside, it actually prevents things.
So you think the price we pay for this then is just 20% downdraft in the S&P 500? We've had 500 basis points of tightening. They've layered on QT on top of that, and we walk away.
No, on the contrary, the price we pay for this is going to be sustained structural inflation. A lot of things, those returns, the easy money, the low risk premium, the great moderation which enabled all of that. We've had in 20 years. That isn't coming back anytime soon. Right?
So what does it mean to step back from the brink then? Because it doesn't sound like we're going to some lovely place.
No, well, even so, if you look at where we are, for the U.S. economy, of the Eurozone economy next year, is there still a chance of recession? Absolutely, right? But probably at best in a mild one, both in the U.S. and the Eurozone. Of course, how the war develops is going to calibrate that too. In China, clearly there's going to be a growth push. But just going back to the inflation view, these stagflation problems that we've seen this year, they're not going to go away anytime soon. And there's going to be a nasty inflation sting in the tail with China's reopening.
Well, Jeff, this is to me a really interesting question because people talk about recession as though that's a negative case for the economy. But how much is that actually the best case scenario is if we get a recession sooner that actually accelerates this process of disinflation and gets us to the end quicker?
So for central banks, and I think the ECB is a good example of this, they present a headline scenario, a baseline scenario, then an alternative scenario, right, depending, on the war. So from their point of view, they looked at an alternative scenario where you in June and March, they're looking at growth contraction of 2%. Well, the headline, okay, that's surely going to drive down growth, but no, it's not. No, that's very stagflationary, right? So you've got to calibrate this very, very carefully. They certainly want moderation. That's what the BOE, has signaled. 2 years of household income contraction. I'm sure friends, back home, John, are telling you, the situation with the housing market and the like. So Governor Bailey and the MPC, they thought that was necessary, but not too much, right? So there's a delicate range there, and we think we're going to be in the okay side of that range.
So next week, BOE, ECB, Federal Reserve, CPI, one more event you've got to look at now. Sam Bankman-Fried is willing to testify on the 13th. He's come out with a couple of tweets moments ago. I'll share some of them with you. I still do not have access to much of my data, professional or personal, so there is a limit to what I will be able to say, and I won't be as helpful as I'd like. But as the committee still thinks it would be useful, I am willing to testify on the 13th. Lisa, he goes on to say, I will try to be helpful during the hearing and to shed what light I can on the following. FTX US's solvency and American customers, pathways that could return value to users internationally, what I think led to the crash, and my own failings. And he rounds things out by saying the following. I had thought of myself as a model CEO who wouldn't become lazy or disconnected, which made it that much more destructive when I did. I'm sorry. Hopefully people can learn from the difference between who I was and who I could have been, whatever that means. So we're looking ahead to next week.
To me, and this is my layman's interpretation, trying to paint this as incompetence or a failure in terms of what he came through on rather than some sort of malfeasance. I'm curious about what kind of legal input he's gotten, given that he's been talking a lot more than they would like.
You're not alone. Shonali Bassett's going to join us a little bit later this morning. Looking forward to that. Anne-Marie's going to be with us here in the studio in New York to break down what you can look forward to next week. Jeff, I want to come to you. We started this conversation talking about a lack of leverage. Maybe a lack of leverage in the traditional places. Is there leverage elsewhere that maybe we can't see in the way that we can in, say, public markets and equities, household balance sheets, corporate balance sheets, that kind of thing?
And also private markets as well. If I think about the asset allocation views over the last few years, with my previous hats on, for example, the increased weightings in private equity into alternatives, with that maturity premium, right, where you lock things in for 10 to 13 years or beyond, and then clip that longevity coupon, when rates are very, very low, that still may come to the fore, BIS talking about shadow lending, et cetera, et cetera. So, yeah, the pitfalls out there still.
FX strategists have been coming on and talking about the housing market as underpinning a lot of their calls. Which housing markets are most vulnerable? Are you as well?
So, yes, Nordics and the Antipodeans, right? So if you look at Australia, right now, if you compare Australia to New Zealand, New Zealand's basically saying, yes, we have a housing market issue as well, but the labour market is so tight, income growth is so strong that they're not worried about it. They're probably the only G10 central banks that can hike more than Fed. They're 5.5, and I wouldn't rule out 6. Whereas the RBA is saying, and they might be wrong on this given the China situation, but income growth is slowing, job markets is slowing, so that means wage growth can't offset higher mortgage rates. UK, that's a well-known story. Sweden's going to be interesting because Ingves, the governor, is leaving. He overlapped with Greenspan for a month, right? That's how long he's been around as governor.
Crazy, isn't it?
It is, but the new governor is the current head of the Swedish Financial Services Authority, knows where the issues are in the housing market. So the risks, but also the reforms needed. So that's where things can really come off.
Where does Canada fit in?
So Canada as well. So when you see the mortgage rates go up, you're already seeing the BOC start to shift to the softer side. We saw initially Canada being like a high beta proxy, to the US. Whatever the Fed's going to do, Canada and Mexico, will follow as well. But now we're clearly seeing that divergence, and in our flow monitor and our flow data, for example, we're seeing clients diverge as well, and they're not owning the CAD right now.
Jeff, this was great. It always is. It's great to have you with us here in New York.
Absolute pleasure to be here.
Jeff Yu of BNY Mellon, just to confirm, from Sam Bankman-Fried of FTX, I'm willing to testify on the 13th.
Yeah, I'm guessing he's not coming to the U.S. though. I'm
Well,
going
we
to
need
guess
to
he's
get
going to do it remote.
confirmation of that.
That's just my.
Is it from the
hunch.
Bahamas over Zoom? Is that what you're expecting?
That's
Does he
my
come to America?
expectation.
Yeah,
Yes.
we'll see.
What do you think? You think he's going to come here?
I don't know. We'll see. I'll wait for confirmation of that. Coming up, Tracy McMillan, the head of Global Asset Allocation Strategy at Wells Fargo.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A surprise from Capitol Hill today. Arizona Senator Kyrsten Sinema is changing her affiliation from Democratic to Independent. That will make the Democrats' narrow majority more complicated. Sinema told Politico she will not caucus with Republicans and indicate she'll keep voting the way she's done her first 4 years in the Senate. Investors will be watching today's release of the U.S. Producer Price Index for clues on what the Federal Reserve may do next. The numbers come out at 8:30 New York time. The forecast for November says that inflation at the factory level fell from 8% to 7.2% over the previous 12 months. Fed policymakers meet on interest rates next week. Bloomberg's learned that the U.S. is preparing more sanctions on Russia and China for what it calls human rights abuses. The sanctions against Russia are expected to focus on its efforts to get weapons from countries such as Iran, especially drones. The penalties against China will center on its fishing industry. And China faces a daunting task after abruptly giving up on COVID-0. The number of infections expected to soar, and deaths are predicted to rise above 2 million. The U.S. and Europe had an ebb and flow pattern of outbreaks over the past months and years, but China is likely to see a wave of infections hit the country all at once. Some of the world's top investors are predicting double-digit stock gains in 2023. That would bring relief after global equities suffered their worst loss since 2008. 71% responding to a Bloomberg News survey expect stocks to rise. For those seeing gains, the average response was a 10% return. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. It's a big week for the U.S. economy, and Bloomberg's got you covered.
My head's spinning here.
First, on Tuesday morning, CPI data comes in.
We're seeing things work themselves out.
This is going to be a really choppy ride.
Then on Wednesday afternoon, a special surveillance will cover the Fed's last rate decision of the year.
Power of that Fed speak is declining.
Does this Federal Reserve have the commitment to keep going?
The question is, how high do they have to go?
The CPI report Tuesday morning and the Fed decision Wednesday afternoon. Right here on Bloomberg, your global business authority.
run a little bit too far as it relates to this rally in yields. But I don't want to lose sight of the big picture. We do believe that bonds are back, and for the first time in a decade, you're getting income and diversification from your fixed income portfolio.
Bonds are back, bonds are back. I've heard that so many times over the last few months. That was the brilliant Cassie Barrow of JP Morgan Asset